The U.S. is the only engine of global growth right now.
There's a lot of opportunity here, assuming the economy continues to grow and profits continue to grow.
The Fed always is a key story here.
I think it will take a few more Fed cuts to push the 10-year above 4.5%.
We're actually getting back to normal. And you can see that if you look at overall inflation trends.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Inching our way towards the holidays, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 5-day winning streak on the S&P 500 and looking to add some weight to the rally. Equity futures right now on the S&P up by 0.5. The outperformance on the Russell, the small caps up by 1.1. In the bond market, a rally across the curve on a 2-year, 10-year and a 30-year. 10s are down 5, 30s are down 6. And that unlocks some dollar weakness against the euro and the bulk of G10. Euro dollar this morning looks like this at 104.88 and positive by 0.7%. The race is over. We can finally stop talking about it. The Game of Thrones down in Palm Beach, Mar-a-Lago, Florida, it's all done. The Treasury Secretary pick is Scott Bessent.
It is Scott Bessent, and that's probably the reason why we're seeing something of a relief rally, this belief that he will be a tempering force for President Trump when he does come to office. I will just say we won't stop talking about it, because now there are a lot of questions about how someone who is very much won his bona fides on Wall Street will moderate a signal from President Trump, who has shown again and again it is his policies and his word that is going to get through.
Well, Terry Haines puts it well. We're going to be speaking with him, talking about this cabinet of rivals. You have someone like Scott Bessent really modulating some of the forces like a Howard Lutnick, who's going to be overseeing trade. Bessent has come out and talked about the fact that when it comes to tariffs, maybe they will be a negotiating tactic. Maybe that needs to be the tool used to actually get to free trade and potentially modulating what maybe Howard Lutnick wants, which is blanket tariffs. The fact of the matter is the markets like it because this is someone who really understands financial markets.
It was a world-class shortlist. It's a world-class pick. We can all agree on that. Most people in markets agree on that. But I think we've said this a few times last week. So let's just paraphrase a quote that we read out a million times through last week. The biggest challenge for Scott Bessent is not executing policy. It's managing the consequential volatility that might undermine those policy changes. We're going to see a big realignment in global trade potentially. Some big moves domestically as well. It's managing the fallout of that that's going to be a major challenge for him.
I would take that a step further and say it's unclear, and he actually muddies the water when it comes to understanding how tariffs are going to be used. Will they be used as a negotiating tool, as he talked about, an aggressive negotiating tool? And some people in China are thinking maybe we're going to end up with a situation where it will be an easier person to deal with, given the fact that he has talked about China being an important ally in certain capacities. It's a different type of rhetoric than the sort of poisonous one that we've heard from other places. There just is a big question mark. To your point, Emery, I think it's the right one about the cabinet of rivals. We're getting mixed messages about what the policy, overriding policy is going to be. And that uncertainty is still present, even though there is this relief rally this morning.
But tapping Mr. Bessent, one thing was clear from Donald Trump. He wants to protect financial markets at all costs. That was what you've called, Jonathan, the Trump put of the first iteration. And that is very near and dear to his heart. And that is very clear with this Treasury pick.
I was going through the to-do list last night, and there are many things on that list. Let's be clear about that. You've got to oversee the maturity profile of the debt. You've got to ensure that debt continues to attract financing. You've got to maintain the faith in the US dollar, which may well offset some of the harm caused by higher tariffs at the same time, that we look to realign global trade. That's a long, long list. But I'll tell you what really stands out for me is very interesting, just in terms of a real-world experiment. We are taking an individual that has made a fortune on anticipating policy changes and the asymmetric bets that they create to getting hold of the levers. I think that's really interesting. This is a guy who knows what the right and wrong policy move is. He's made money off that through a long, long career. Now, finally, he gets to control some of the levers.
There's a quote that Scott Bessent said in an event in June, and I thought this was really telling. We are going to have some kind of grand global economic reordering. I'd like to be part of it. I've studied this, says the Yale professor, the hedge fund manager who is now rising to become Treasury Secretary.
Equity futures right now on the S&P rising as well, up by 0.5%. Coming up this hour, we'll catch up with Lucy Baldwin of Citi, following a solid week of gains. Terry Haines of Pangaea Policy as Donald Trump picks Scott Bessent to head Treasury, and Jane Foley of Rabobank as the dollar rally reverses course. We begin this hour with stocks looking for a sixth straight day of gains as markets welcome Trump's decision to nominate Bessent for Treasury Secretary. Lucy Baldwin of Citi is still cautious, writing, "Our expectation is that current consensus for 2025 is aggressive, and this is before tariff concerns can be modelled. So we expect the post-election rally needs to pause and pull back." Lucy joins us now for more. Lucy, welcome to the programme. Let's try and look ahead to 2025. Are you making any assumptions whatsoever when it comes to taxes and tariffs?
Hi, Jonathan. Great to be with you. Yes, as we look into 2025, you've obviously now shifted from election uncertainty to policy uncertainty. And as you say, there's the sort of four pillars of policy, right? You've got the sort of pro-growth cyclical levers where you've got clearly some expansionary fiscal policy. Now we know, we've obviously got Scott Bessent in the Treasury, so people feel more comforted that that's not going to lead to too many challenges from a deficit perspective. But you've also got, obviously, the sort of more pro-growth policies around deregulation, and we're seeing that play out in financials in the market. But when we look into next year, like a lot of people across the street, we're not changing radically at the moment at this stage our growth forecast for the US economy. I think most people, if anything, are slightly edging up their GDP growth assumptions. Most people assume that what we're going to see isn't going to be too inflationary. And those, of course, are very big assumptions. But right now, I think as people calibrate those pro-growth policies, obviously potentially offset by tariff, trade and the immigration policies to some degree, that seems to be where it's landing, is that most people expect some moderation in US growth next year, but not radically so, and an element and taste of US exceptionalism still very much there, Jonathan, as we look into next year for growth for the US.
You say that, Lucy, and yet you're not changing your view, and the market is changing its view. So you have this contrarian moment where Citigroup, on the margins, is leaning into some of the weakness in Europe and away from some of the U.S. exceptionalism that you've seen. Can you talk about being contrarian at a moment like this tactically, even if long-term, you still see that American exceptionalism is in play?
Yeah, and I think that the parts of our calls that are contrarian, to your point, right, our base case for the S&P this year is still 5,600, right? 6,100 is our bull case. And we look at next year and we say, look, 15% earnings growth, which seems to be what the sort of consensus forecast still looks like to us, is quite aggressive despite tax cuts and everything else and deregulation. So we feel like that, when you have a sort of 23 times earnings setup, is quite a tall hill for the market to climb to go on from here. So we've got that's contrarian. The other thing that we still have that is a contrarian call is a view that we may still get outsized rate cuts this year. Obviously, non-farm payroll data in December is going to be key after the weakness that we saw in November, caused partly by, obviously, hurricanes and strike disruption. But if that is another weak data point, we wouldn't rule out another 50 basis point cut. Now, I think if you saw, 25 or 50 basis points of cut, that's probably going to support the market. But I think to see a real Santa rally into the back end of this year, it's obviously going to require a little bit more. Now, all of that said, we're definitely not telling people to sell their exposure to the US market, right? We're still saying, look, you've just got to be a little bit more selective under the hood here. And there's lots of pockets of the US market that we really like. But to your point, we have coupled that now with a barbell approach. So we've also said to people, look, keep the US, think about that exposure, pick some new sectors perhaps under the hood, think about the broadening thesis in the US, but add, if you can, a barbell approach to have some Europe, because obviously Europe has been incredibly beaten up for lots of obvious reasons, right? Positioning is incredibly light, but you are going to see, we think, that continuation of fairly aggressive ECB rate cutting, which is going to support Europe, and you have got this chance of the German elections really triggering a bit of a reset moment for Europe. Obviously, a smaller version of what you're seeing in the US in terms of regulatory reset and fiscal stimulus that could be on the cards for Europe. So if you can barbell it, that is definitely what we would suggest here.
When you say go into Europe, are you talking about the bond market with ECB rate cuts? You're talking about stock markets that could actually get beaten up by the idea of tariffs, U.S. exceptionalism continuing, and frankly, a lack of innovation at a lot of companies that's even been flagged by Christine Lagarde.
And I think you're right. Europe has got a huge number of structural challenges that it's grappling with, but to some degree, a lot of those things are priced in to the European market. So, for example, things we would like in Europe would include financials and tech, right? So we think there's lots of opportunity still in sectors like that. Sectors like industrial goods, capital goods, are going to see some pretty significant changes. Of course they are. So we'd be a little bit more cautious there. But a recent upgrade we've made within European equities is actually on the resources side, right? Because again, we feel it's been so beaten up. It's a sector that's performed so badly on the back of all of the obvious to do with Trump, tariffs, China, and all of the risks around that. But we actually see there's some potential there because, again, although the China stimulus, for example, has been a little bit disappointing, we think there would be more to come there. So we've recently upgraded this year's China GDP a little bit, just to 5%. We haven't got huge confidence on next year, but I think to your comments, right, as this trade policy becomes clearer as we go into next year, it may well be that it's much more around negotiations. And that obviously looks quite different compared to the sort of more bear case scenario for tariffs, which is a sort of, broad tariffs on everything, right? There's a huge range of outcomes you could see, some of which are clearly significantly less bearish for Europe than is probably currently priced into the market.
Lucy, do you have a sense of the to-do list when it comes to tariffs? Who is going to be the first?
Well, this is a great question, right? I think so that clearly the consensus is China in almost all formats, right, is going to be a focus. Europe is clearly going to be a focus to some degree, sometimes by sort of default. The other one, of course, is Mexico. And actually, this is where we put on an interesting trade more recently from an FX perspective, because we actually think, shorting the euro relative to Mexico might be quite a good trade here, because perhaps Mexico, although it's performed as you perhaps would expect, given the focus on Mexico by Trump in terms of the narrative, we think that relative to China and to Europe, it's probably going to come off less badly. So we think that might be another way of thinking about how these tariffs come through, taking it from that perspective as we look into next year. But I think you're right, absolutely China is going to be incredibly exposed, and Europe. But those are the three markets in aggregate that are going to clearly be in the firing line.
Given we know that China builds factories in Mexico and they try to use Mexico as his back door, why don't you think Mexico will be one of the first countries that Trump wants to make sure he deals with?
Well, I think we've got a big debate on Mexico that's clearly ongoing at the moment. Is it a sort of bridge to China? Is it a buffer? And I think that it'll be one of those areas where Trump is obviously going to look to Mexico to really help the implementation of their immigration policies. And again, that's another area of policy uncertainty, by the way, which is hugely unknown at this stage. I mean, most people's base case is a slowing of immigration into the US, but it's not an outright reversal at this stage, right? But I think he's going to clearly want to work around immigration. To your point, he's clearly going to work on it not being the back door. And in which case, I think, although we've seen signs of that already being agreed between Mexico and the US, I think they're going to want to get that agreement in place and implemented well in advance of the USMCA, which comes up for that renegotiation in 2026. Mexico is hugely important, don't forget, to the United States. It overtook China as the #1 country that the US is importing from. So to try and tackle both Mexico and China incredibly aggressively would be hugely problematic for the US from a growth perspective. Trump knows that. He doesn't want to see huge inflation coming back to the United States. He knows that's how he's got himself back to the White House. So you've got to remember they're going to be incredibly pragmatic dealing with inflation, and to do both China and Mexico very aggressively from the get-go, I would imagine, is incredibly difficult to manage from an inflationary perspective.
Hey, Lucy, smart as always, and good to hear from you. Lucy Baldwin there of Citi. Just finishing that conversation there on trade, China, Mexico, Europe, of course, a factor in all of this as well. Euro dollar 104.86. This morning, a stronger euro. A little bit later this hour, we'll catch up with Jane Foley of Rabobank, who's looking for a move to parity in 2025. I think the right question to ask right now, Lisa, is how little things need to go right in Europe to generate a big move higher in Europe and the euro and European equities.
Well, that's the fascinating part of Lucy's point here, is that their forecast hasn't changed dramatically for U.S. growth following the election. So if their growth model hasn't changed dramatically, then maybe the dollar on the margins has gone too far, and it wouldn't take much for people to really have underpriced Europe, which is why they're leaning in. I think that is the right question at a time where we get yet another negative economic read out of Germany, and everyone's sort of just kind of shrugs. It's like, what else is new? So, it turns the other way for a hot second and everybody will buy the euro.
Euro dollar 104.85 is getting bought this morning. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Apple CEO Tim Cook in China for at least the third time this year. Cook attending a supplier conference in Beijing. The Apple boss is also expected to join a meeting of foreign CEOs with the Chinese premier. The meeting is expected to address supply and trade issues ahead of the incoming Trump administration. Elsewhere, Gautam Adani and his nephew Sagar Adani have reportedly been summoned by the SEC to explain US allegations in a $250 million bribery case. News agency PTI says they have 21 days to respond to the legal requests. And finally, Wicked and Gladiator 2 bringing in a combined $170 million in US and Canadian theatres over the weekend. Wicked finishing in first place with $114 million in ticket sales. Gladiator 2, the sequel to the 2000 Best Picture winner, grossing $56 million to finish second. It's quite a weekend here in the United States.
It's always the redos. It's always the ones that are kind of banking on an existing franchise. I'm looking forward to when they create a new franchise, or they really go out there and there's a new superhero, or,
I'm looking forward to going back to the theater since I haven't been, because I will go back for Gladiator 2.
You're still pitching. She's still going for it.
I'm going to watch Gladiator this weekend.
You are?
Yeah, I'm in love with the original. I imagine I'll be disappointed by the sequel.
100%.
But I'm still going to go back and torture myself with it. Up next on the programme, Donald Trump's Treasury Secretary.
We had a Trump presidency that delivered low inflation, the high real wage growth, and good economic growth, especially for working Americans. I think it's absurd to say that Donald Trump would be inflationary.
The latest on the man himself, Scott Bessent. That conversation up next, live from New York City this morning. Good morning. Live from New York, welcome to the programme. Equity futures on the S&P 500 up across the board, a rally in the bond market, unlocking just a little bit of dollar weakness. Euro dollar 104.84. Under surveillance this morning, Donald Trump's Treasury Secretary.
We had a Trump presidency that delivered low inflation, the high real wage growth, and good economic growth, especially for working Americans. I think it's absurd to say that Donald Trump would be inflationary. If bond yields go up, they would be going up because there is a growth impetus, and the market would price in a higher growth trajectory. In my mind, it will not be, because inflation will be going up.
So here's the latest this morning. The wait is over. President-elect Donald Trump picking money manager Scott Bessent for Treasury Secretary. Terry Haines of Pangaea Policy writing, Friday's Bessent Treasury nomination and economic policy team of rivals is more evidence that Trump's economic policy isn't a settled thing. There are no guarantees Bessent is the top Trump economic advisor or is able to drive Trump policy in Congress, both requirements of the job. Terry joins us now for more. Terry, let's just take a step back and think about the process over the last few weeks. Is there a signal that you take from the process?
Well, the signal I take is that it's the policy is still developing, frankly. I mean, you've got, and that's not unusual for incoming administrations. You've got a lot of people, as you've seen, a lot of people wrestling around, what the priorities should be and what the policies should be on all kinds of matters. And economic policy is no different. And, now you've got this situation where Bessent and Lutnick were duking it out over the Treasury Department. They're both going to be relatively close advisors. They'll be joined by some other people as well. So, that's not completely filled out. And the question is going to be, who's going to be the most effective? Who's going to help sell the policy? And frankly, who's going to be the lead horse whisperer here for the president?
Given this team of rivals, how important is it to have someone at the NEC that can bridge that gap between Treasury and Commerce?
I think it's very important. The NEC position has grown in stature over time. It's been somebody in the last few administrations who has been kind of personally close to the president in one way or another. And a third voice is really going to be necessary to make sure that the best policy is going to happen. So,
given what you know about Scott Bessent, who has won out after this 2-week soap opera of who was going to get that top job. What do you expect him to really want to prioritize on day one?
Well, excuse me. Bessent thinks about this very much the same way I do, which in the clip you ran in the bumper says it. You know, Trump is not going to, politically and practically, Trump is not going to want to take a situation where he won in part by saying, you know, Trump can fix what Biden-Harris caused and immediately launch into an economic policy that doesn't start fixing things or arguably makes things worse. The three things I would say about Bessent briefly are, you know, kind of positive, neutral, negative. One is positive is that he's practical. He comes from a practical background, and markets always like that and think it's important. The team of rivals thing, as we've talked about, I think is very much leaves economic policy somewhat up in the air. Because thirdly, what you have to remember is the Treasury Secretary is what he or she is, but those people are staff. And if you think that Bessent's going to have a free hand in some of this stuff, I advise you to give Janet Yellen a call. Markets thought 4 years ago Yellen was going to really moderate a lot of the more inflationary aspects of the Biden policy coming in, and, you know, whoops, that didn't happen at all. So, you know, Bessent's going to have to, nobody's going to hand Bessent the reins here. He's going to have to work for him.
Terry, you talk about a team of rivals. David Sanger of the New York Times put it as sort of three distinct ideologies that are emerging. The revenge team, you're looking at, for example, the idea of ripping apart the Justice Department. The Calm the Markets team, which consists of Scott Bessent. And then the government shrinkage team, which is Elon Musk and Vivek Ramaswamy. In any world, are these three ideologies peacefully coexistent?
Well, you know, the New York Times is big on ideology. I think it's, I think this is less so. I think what it is really is a scrambling for what the priorities of the administration are. And, you know, one of the many ways, I don't diss at all the kind of brief that Musk and Ramaswamy have. I wish them well. I wrote in a piece a week or so ago, you know, I'm for at least half of what they want without even knowing what it is. I mean, that's how over bloated Washington bureaucracy is. And so, you know, they've got a big job in front of them. But the likelihood that they achieve any of those is, you know, as everybody's pointing out, is slim to none. Ronald Reagan found that out, of course, and what Ronald Reagan focused on was economic recovery. Then that makes most sense for Trump as a president. That makes most sense for Trump as a lame duck president who's trying to become the bridge into a next Republican president, whether that's Vance or someone else.
Terry, there is one ideology that sort of stood out to me anyway, which is consistent, and that is in all of the healthcare nominees. And I know this is a bit of far afield, but you see the S&P Pharma and Biotech Index down some 6% because since the beginning of this. Is there some real sense, when you talk to market participants, are you telling them, yes, this is going to be a real breakup of the norm when it comes to healthcare?
You know, what I tell them is I think it's going to be incremental at best. You know, what you have in Bob Kennedy, and he's not alone here. I'd put Congresswoman Gabbard and Pete Hegseth in this box as well. Are people who are meant to be disruptors, but at the same time don't really have any experience or any serious idea about how to disrupt and how to do it effectively and well. You know, the Biden administration is. Excuse me. Biden administration is useful in this as a comparison here. Drug pricing was a very big deal to these people, and after 4 years, pretty much all they got was an agreement on renegotiating the prices of a few drugs under Medicare Part D, and they didn't even roll that out quickly. You know, people underestimate the time and the effort that it takes to turn the battleship around.
Terry, appreciate your time this morning, sir. Thanks for your input. Terry Haines there of Pangaea Policy. Manus Cranny was talking about this earlier this morning as well. Markets move really quickly. You've lived Washington, D.C. Washington, D.C. does not move really quickly.
And that's probably going to be the one hurdle, really, for Scott Bessent. He understands markets. Does he understand how slow the Washington complex actually works?
That conversation will continue. Up next on the programme, we'll catch up with Mike Darda of Roth MKM and why tariffs would make the Fed's job a whole lot more difficult. That conversation is just around the corner. 5-day winning streak on the S&P 500. Make it day 6 potentially. Equity futures up by 0.5%. Outperformance on the Russell. The small caps rallying hard, up by 1 full percentage point. The wires in the bond market, there's a rally. After a 4-day sell-off at the front end of the curve, the 2-year yield is lower by 3 basis points. Lisa, 4.34.
Scott Bessent has actually made a real priority of reducing the deficit. That's one of his goals. It's one of the reasons why he is so passionate about getting into service, which is the reason why Treasury markets are relieved, thinking, okay, this is somebody who is not going to allow President-elect Donald Trump to actually get this deficit sky high. Here's a question. How is he going to do it? He's also talked about issuing longer-dated debt as opposed to concentrating issuance in the short end. Can you affect that with this kind of somnolence in the bond market?
Can I offer some slightly different framing?
Please.
Pick up on something that Anne-Marie was talking about last week. This move today is not about who he is. It's about who he isn't. We had a really, really good list of 4 people. There was a fear that maybe it wouldn't be one of them, that it might be someone from like way out there, who knows? Like the dark horse candidate we were talking about was Senator Haggerty.
Right.
It could have been someone completely different.
Right, it could have been someone, I mean, if you look at some of the other cast of characters, part of this cabinet actually plucked from Fox News. It could have been maybe a financial journalist, who's to say? So I think that's right. Everyone was talking about a dark horse being someone who is still a top caliber individual who the market would have embraced as someone to steady the ship. But the real dark candidate was someone no one was even talking about. And if this tension continued to brew in Mar-a-Lago, potentially we could have seen that.
Which brings back a little bit of a bid to the bond market, which unlocks some dollar weakness. And you see that, Lisa, across G10. The dollar weaker against pretty much everything, including the euro, the yen, and sterling as well. Trying to extrapolate out these moves out a year, 6 months, 3 months, 5 minutes.
2 days.
I think it's super, super hard.
Yeah, well, I mean, I think that your framing is correct in terms of this is an embrace of someone who Wall Street really has raised. And I think that that's the issue, is that there is a nod to the idea that Donald Trump does not want to disrupt markets, and that to the extent that he wants to rip up the norm, that is not the case when it comes to Wall Street. You know, again, the details will matter, but not right now. So that's the reason why, for now, we can say this is a relief rally. To your point, how long can it continue?
Euro dollar 104.84. Under surveillance this morning, if you are just joining us, the top story over the weekend, President-elect Donald Trump nominating Scott Bessent for Treasury Secretary. Bessent telling the Wall Street Journal he'll focus on following through on Trump's tax cut and tariff plans once he takes office.
And he's talking about this idea of an economic lollapalooza when it comes to deregulation, boosting energy independence, and offering up some of these tax cuts. And then to Lisa's point, really cutting the deficit. How he does this, what's the sequencing of this, that remains to be seen, especially if there is this cast of characters and it's a rival cabinet, the way Terry Haines is talking about. But Jonathan, you said something very interesting at the top of the show. He made his money looking 6 months, 12 months out. Huge bets. I mean, we are talking about trades this man put on with the likes of George Soros and Stanley Druckenmiller, betting against the Bank of England, betting against the Bank of Japan. It's interesting, in one of the opinion pieces this morning on Bloomberg, it talks about his colleagues talking about his uncanny ability to read newspapers 6 months ahead of time and now have the ability to potentially be on the other side of those trades and direct policy.
It's going to be an amazing experiment in real time. Lisa's talked about this a few times over the past few weeks. Guardrails, checks and balances. Some really important observations over the past week alone. We've had some people come out with conspiracy theories that Elon Musk is somehow some shadow vice president. I think an important observation to make this morning is that Elon Musk wanted Howard Lutnick and we've ended up with Scott Bessent. Point 1. Here's point 2. Some other people have made this point that Donald Trump, president-elect, will have unchecked power in Congress. I think we have to make 2 observations there as well. 1, we've ended up with a very different Senate Majority Leader to the one that arguably some of the people closest to him wanted. And 2, they're not just going to fold over in the Senate and give him everything he wants. That's why Matt Gaetz has dropped out. It's why we've had a second AG pick. So we are getting, I think, a better read as time passes by on just how strong the checks and balances will be in certain places.
This has also given people a sense of calm, at least in markets, that you can't really move too quickly. I would just caution, of course, that it is early days because we don't really have a sense. You mentioned Elon Musk in particular, and maybe he didn't have influence with the Scott Bessent pick. At the same time, there was a call with Google over the weekend with Donald Trump, and Elon Musk was on that call. That was an unexpected mess. Unexpected. This is according to reporting by The Information. I just don't still have a clear sense of what the first buddy actually is and what kind of influence that is. At the end of the day, Donald Trump makes his decisions, and that much has been made clear. And to the extent that Elon Musk had unfettered access, well, that was just tempered.
Yeah, and I think Scott Bessent is the most recent example of that. But to your point, of course, Rick Scott was the other one. Elon Musk was really pushing for this individual. You can just see his political influence goes just so far. At the end of the day, it's Donald Trump's decisions and also the people around Donald Trump, like Susie Wiles.
The super early days, but just reading the tea leaves. Just reading the tea leaves as the days pass us by. Let's turn to this story. NVIDIA's biggest customers are looking to reduce their reliance on the chip maker. Amazon Web Services, Microsoft Azure, and Alphabet's Google Cloud Platform all developing their own AI chips. Amazon standing out with the broadest portfolio of custom chips.
So to me, there's a couple of questions here. First of all, Amazon wants to counter NVIDIA. How much do all of the big tech names want to actually support that effort simply because they don't want NVIDIA to have such an upper hand? There's also this investment that they've made with this AI startup. They've invested some like $8 billion in this AI startup, basically saying to them, please, the one prerequisite is use our chips. And that AI startup has come to them and said, okay, we will, but it's important to have all chips, including NVIDIA. So there are limits to how far you could use Amazon's chips in the large language models.
That's the latest on that front. I wanted to turn to this story as well. The NATO Secretary General Mark Rutte met with President-elect Donald Trump over the weekend. NATO saying the pair discussed the range of global security issues. Europe waiting to see how the next administration will approach the war in Ukraine. Of course, we've caught up with the former Dutch Prime Minister a few times on this programme over the years. I remember the last conversation we all had with him in Davos, Switzerland, and he turned around as the Dutch Prime Minister and said, you know what, Donald Trump was right. And you said at the time there's a close relationship there. And if he did become the head of NATO, we'd have a very different relationship at the top and between President-elect Donald Trump.
When it comes to all the European leaders, he was one of these individuals in the first iteration of Trump that almost was a Trump whisperer. He was able to deal with President Trump in a way that you were not able to see with, say, Chancellor Angela Merkel. When we spoke to him at Davos in January, he said the U.S. accounted for about 50% of NATO economic output during Trump's term, but about 75% of military spending. That is why it led him to believe that Trump had a point. And then to this meeting, I am not surprised they met alongside Representative Waltz, who's going to be Trump's national security advisor. In January, he told us you have to dance with whoever's on the dance floor, whoever that partner is. And that's who the American people elected.
I want to understand what this means for Ukraine, considering the fact that Mark Rutte has been a proponent of Ukraine's independence and ability to fight back. Does that temper? Does that offer some sort of check to your points earlier that were really spot on to Donald Trump's impulse to withdraw funding altogether?
We'll see. We've gone through a lot of issues in the last 5 minutes, haven't we? And they're really, really big issues for 2025. These are issues the Fed's got to grapple with as well. Investors are waiting FOMC minutes out tomorrow as uncertainty over the incoming administration's policies clouds the outlook for interest rates. Michael Darda of Roth Capital Partners writing, headwinds to the supply side from a tariff shock and slower labour force growth will make the Fed's job of guiding nominal spending in a non-inflationary manner much more difficult. Mike joins us now for more. Mike, welcome to the programme, sir. I want to talk about labour force growth with you and just take a step back away from the conversation about 2025 and think back to the last 12, 18 months. To what extent has labour force growth bailed out Fed Chair Jay Powell?
Thanks for having me on, John. Great discussion this morning. Look, Fed Chair Powell has said on many occasions that a rebound in the supply side of the economy has been very important in the Fed achieving both lower inflation and what's been, a soft landing. So the last 6 quarters, we've had a situation in which real growth, real GDP has actually accelerated, but nominal GDP has slowed down. So one is the demand side that the Fed controls, and the other, real growth, has been doing better because productivity growth has rebounded. Part of growth potential is obviously productivity. The other part is the growth rate of the working age population. So with stronger immigration flows, that has certainly helped on that side. And what we see is, nominal wage growth has decelerated pretty significantly. Recessions typically happen when top line growth, nominal GDP, falters relative to slower moving cost variables. That puts pressure on profit margins, leads to layoffs. and a rising unemployment rate. So far, the Fed's been very, very fortunate that we haven't ended up there. So, what we're trying to say in the note is that anything that disturbs the supply side of the economy and this rebound in the supply side that we've enjoyed over the last 6 quarters will make the Fed's job more difficult.
So, Michael Darda, as you know, the Federal Reserve would refer to labour force growth. Republicans would call it what it is, illegal immigration. Now, Mike, Republicans have been elected for many reasons, one of which in many places is illegal immigration, and they're willing to do something about it. Do you have any expectations, any base case assumptions on what 2025, 2026 will look like in that regard?
It's really cloudy now. I mean, you've had a lot of verbal proposals out there on the tax side and the immigration side. Obviously, I think there's going to be a strong effort to secure the border. Beyond that, in terms of deportations and how significant that is, I really think it's up in the air.
So basically, we're talking this morning a lot about how there are a number of checks on some of the broad-based assumptions initially with the Trump trade. You raise immigration and a question of the unknowns of how that will affect the labor force, but also the tariff trade and the idea that this would somehow amplify inflation. You push back against that, too. You think that the market response to tariffs will be the opposite, will be deflation, and then that could actually pressure things downward, whether it's growth and whether it's inflation.
Absolutely. So, you have to go back about 100 years to see an environment where tariffs went up dramatically across the board. And that happened in the 1930s. So that was not an inflationary period. That was a deflationary period. The Fed was really responsible for that, obviously. It allowed the money supply to collapse by a third and nominal growth to collapse by almost 50%. So those two things aren't going to be repeated this time. But a tariff is a relative price shock. That's different than a monetary inflation. And so a tariff in and of itself is not going to lead to sustained higher inflation on a repeat basis unless the Fed is conducting monetary policy in an inappropriate manner. So the tariff shock makes it tougher for the Fed, I think, in terms of trying to see through those supply side shocks and perturbations. But in terms of what would drive inflation higher in a sustained way, it's really a matter of the Fed and how it conducts monetary operations.
Michael, a lot of people have been saying that because of the red sweep and because of some of the policies that are confusing, when you put them together to really get a clear read, they make it a lot more difficult. Nonetheless, the consensus is that the neutral rate is going to be significantly higher, at least somewhere between 4% there and about. Do you agree? Do you think that basically this means the Fed just can't cut rates nearly as quickly because of the lack of certainty of what the end target is?
Yeah, great question on the neutral rate. I mean, that's really the answer to why is the economy not crumbled with all these Fed rate hikes? Now they're reversing course, obviously, and starting to cut rates. And I think the answer to that is that the neutral rate in a hot business cycle with higher inflation than we saw in the previous cycle is much higher. So, when Fed Chair Powell began this rate cutting effort, what was he saying? He was saying our policy rate is above all estimates that are mainstream of the neutral policy rate. That is no longer the case with the Fed having cut rates 75 basis points in nominal terms. In real terms, it's a little more because inflation expectations have bounced back modestly. So now the Fed has the policy rate, sort of right in between the highest and lowest estimates out of, quote, the mainstream to quote or reference Fed Chair Powell. So it's really going to be data dependency from here on out. The Fed isn't sure where the neutral rate is. My sense is they're still at least modestly restrictive. But you're exactly right. And one real simple statistic, I think, can tell us why. If you look at CPI inflation from the sticky price sector, core, excluding housing, it's running about 100 basis points above the average from the last cycle. And so if you tack down 100 basis points to the peak Fed funds rate from the last cycle, that takes you into the low to mid threes for the nominal Fed funds rate. So, that's below where we are today, but it's much higher than the Fed policy rate peaked in the last business cycle. So the neutral rate is higher. Fed doesn't know exactly where R star is, but they're probably now more confident that they're not above all estimates of neutral.
So what does that mean for the Fed in December, Michael?
Yeah, I think it means that we could be getting close to a pause. It's really going to depend on the flow of data. Markets still think that there's more of a probability that they cut another 25 basis points, but after that, I think things really slow down, and it depends on the flow of data, probably more weighted to these labor market reports. And we've had some strange reports. I mean, going into the summer, it looked like the labor market was faltering into a potential recessionary pattern. And then most recently, the unemployment rate has pulled back. Obviously, the October data was storm distorted. So I think we're going to need more information. The Fed's going to need to see more data, but I think they could be getting close to a pause here.
Hey, Mike, appreciate your time as always, sir. Mike Darda there of Roth Capital Partners, looking ahead to the Federal Reserve minutes a little bit later this week. In the bond market this morning, yields are lower by 5 basis points on a 10-year, 435. With an update on stories elsewhere this morning, here is your Bloomberg brief. We start in Israel. Israel's ambassador to the United States saying the country is close to a ceasefire deal with Hezbollah in Lebanon. It's unclear whether Hezbollah would accept a deal. The Iran-backed militant group fired at least 250 rockets and drones into Israel yesterday alone. UniCredit making an $11 billion all-share bid for rival Banco BPM. Acquiring the company would make UniCredit Italy's largest lender by total assets. CEO Andrea Orcel also pursuing a merger with Germany's Commerzbank, which is facing opposition in Berlin. And finally, Max Verstappen securing his 4th consecutive F1 championship at the Las Vegas Grand Prix over the weekend. Verstappen finishing only 5th in Las Vegas, but managing to outscore rival Lando Norris, making him only the 6th driver in F1 history to win at least 4 titles.
Aren't you sick of him winning? I mean, isn't it like kind of boring? It's like, yeah, Max Verstappen won again.
So typically it's boring if they have the fastest car. I think that we can make a pretty strong argument. We can all agree that he did not have the fastest car to win the championship with, so it's pretty impressive. I think Max is a beast and deserves a ton of credit.
So he's going to be the Michael Jordan of F1?
I wouldn't go that far. I think that's still Lewis Hamilton.
Okay.
And Lewis Hamilton is going where next year? Ferrari. What a beautiful thing. Oh. All right, enough on F1. Up next on the programme, a sigh of relief.
Besant has to remember the relative story here, which is the US economy is doing far better than Eurozone, others. The key here is delivery, right? And also, how does he reconcile necessarily what he aspires to? Does that always align with what President-elect Trump aspires to?
That conversation up next, live from New York. You're watching Bloomberg TV. The equity market rally continues, up 0.5% on the S&P following a week of gains and a day of gains every single day last week. 5-day winning streak on the S&P. Under surveillance this morning, a sigh of relief.
Besant has to remember the relative story here, which is the US economy is doing far better than Eurozone, others. The key here is delivery, right? And also, how does he reconcile necessarily what he aspires to? Does that always align with what President-elect Trump aspires to? I think the thing that would save, if you like, save the story massively would be if the US economy continues to perform well, right? Growth covers a multitude of sins.
So here's the latest. President-elect Donald Trump naming Wall Street veteran Scott Bessent to run Treasury, widely viewed as a safe-hand candidate, triggering a relief rally in bonds and unlocking some dollar weakness following 8 consecutive weeks of strength. Jane Foley of Rabobank expecting dollar weakness to be temporary, looking for euro-dollar to move to parity around the middle of next year. Jane joins us now for more. Jane, welcome back to the show. As always, it's good to see you. Let's talk about that dollar strength you expect to resume. What underpins it?
Well, thanks for having me. Well, to be honest, I don't really see an awful lot of carryover from the pullback that we've seen today. You've got to bear in mind that at the start of this month, we were still trading just above the 109 area quite briefly. So the dollar has made a huge amount of gains in just the past few weeks. So I think pullbacks were inevitable. We didn't know what the trigger would be, and hence we've had the trigger. But I think you could look at this pullback in a slightly different light and say, isn't it amazing that euro dollar hasn't gone further? That we are still trading below 105 this morning. And essentially, I think it's really, really important to not just look at the US fundamentals, but actually to cast, a strong light on the Eurozone fundamentals too. And what we have in the Eurozone is I think, a weak Euro story. And I think that is something that's going to pull euro dollar lower.
Jane, that said, you said it's surprising that you're not seeing more of a bounce, given that there's some sort of catalyst. At the same time, when it comes to the fundamentals, there was German business confidence that came out overnight, and it was worse than expected. So the actual data is really backing up this move. Do you get the sense the bar is pretty low? That if we get even just a little bit of economic data out of the Euro region that's positive, you get a bounce, given the fact that we've kind of stabilized a little bit, maybe, for half a day in the dollar?
You know, I'm not so confident with the euro. You know, one of the stories I think was being really quite exceptional for the G10 FX market in most of this year, certainly the first half of the year and part of the summer months too, was the resilience of the euro. The euro just wasn't going down, and I think part of that was this expectation that Germany was going to bounce back in the second half of the year because we were going to have real household incomes push higher, the consumer was going to return. That hasn't happened, and I think the market is going through this adjustment now of expectations, which is fundamentally that the German structural issues are going to take a lot longer to work through. So these adjustments with respect to, the energy crisis, for instance, the loss of cheap Russian energy, the fact that the labour market's very different, much more constrained in Germany, the fact, and I think this is really important, that the Chinese market has really changed. For decades, German manufacturers were exporting machine tools, and now a lot of that manufacturing goods, cars, EVs particularly, is coming back right at Germany. And if you look at what VW is saying, you look at what Mercedes is saying, there's big structural problems there, and I think they could probably welcome a weaker euro.
Given the fact that we are seeing a bit of a relief rally today, I think it's worth looking at Scott Bessent and the Treasury Secretary pick and what some of his views have been on the currency. In the past, he's really made a point of saying that it's important to maintain the status of the dollar as the world's reserve currency. Do you think that will underpin maybe greater strength, maybe a move away from gold on the margins, and a structural shift toward parity for a longer period of time?
I think it certainly could. We've got to bear in mind, that the dollar index has been slowly climbing higher since around about 2010 anyway. And I think this can really accelerate the move. Now, if we look at the US Treasury historically, there has been a strong dollar policy. We know that there's a question mark with respect to Trump's view because he wants to address, the US trade deficits in goods with countries such as China, etc. So we know that in his previous administration was a reason that he would have favored a weak dollar. But Trump recently said too, that he wanted the dollar to be maintained as a global reserve currency. Part of, having a strong dollar is part of that because it implies, confidence. It implies that it is a currency that other central banks, want to have in their reserves. So certainly that does reinforce that view. And also Trump gave the implication that rather than using a weak dollar to sort out the trade imbalances, then instead, it was tariffs that became, that beautiful world. So again, maybe Trump too has changed his view on the outlook for the US dollar.
Hey, Jane, appreciate your time and input, perspective on foreign exchange. Jane Foley there of Rabobank. We're talking about how quickly Donald Trump, President-elect, might move. Let's talk about a region that moves really, really slowly. Europe. UniCredit boss Andrea Orcel with this to say on Commerzbank on a morning where we're talking about an $11 billion bid for BPM. They say this on Commerzbank: the probability for a Commerzbank deal is lower than expected. The probability has been reduced, but it's not zero. It's just been reduced.
The German government doesn't want this. And basically, they're going after a domestic company because it's more likely they can get that through at a time where there is political turmoil across the continent.
Orcel saying the timeline will be longer than thought to try and secure Commerzbank. That's the latest on that front. Up next on the programme, David Bianco of DWS will speak to Henrietta Treyz of Veda Partners, Clint Henderson of The Point Sky, and Yih-Tennant of Columbia Threadneedle. From New York, the second hour of Bloomberg Surveillance. Up next.
Tariffs will have an impact on pricing behavior by companies.
Raising tariff prices across the board, there has to be an offset.
Tariffs are probably going to hit both consumers and corporations.
We definitely see consumers still being choiceful. That value shopper where there is style and product is working.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now as we face down a holiday-shortened trading week, the right kind of week, the kind of week that we all like. This is what the week looks like. You're going to get jobless claims on Wednesday, so just put that one in the diary. That's really important. Typically it falls on Thursday. We won't be here. You will get that on Wednesday. Together with some Fed minutes in the next 24 hours, consumer confidence numbers as well, lead to a really condensed trading week for the week ahead.
The focus really is going to be on PCE that comes out on Wednesday. Do we get a sense that that onward disinflation will allow the Federal Reserve to cut by 25 basis points next month? That story that feels like an old, tired sweater that you're bringing out because suddenly you have nothing else to wear because you've talked over all of the other items. That said, I do think it's important to see whether the Fed will be colored by some of the changes in market expectation about the path ahead for policy as they give some of the projections next month.
We at least know who the Treasury Secretary will be, Scott Bessent, and it's unlocked a rally in this equity market. Check it out. Equity futures on the S&P up by 0.5%. In the bond market, this is the rally. Can we call this the Bessent bump? Maybe. 2-year, 10-year, 30-year.
How long did you work on that?
Yields down by 4 basis points. Came up with it over the weekend. Tons of thought. Tons of thought. 10s at 436, 2s at 435.61. Those moves unlock some dollar weakness. Let's see how temporary this might all be. Euro dollar inflecting just a little bit higher. Firmer on the session on the euro. We're back around 105 at 104.81. Bessent is your man.
He's the man for the Treasury job. This comes after 2 weeks of jockeying down in Mar-a-Lago. He was the man that was really everyone thought was going to get the job. Then a ton of tension brewed, and then more names were thrown in. And then Donald Trump ended up where he started this search, back to Scott Bessent, an individual who's been on the campaign trail with him, an individual who's been advising him for the past year about economic policy, things that he talks about. Deregulation, boosting American energy independence, and cutting the deficit. And I imagine cutting the deficit is music to the ears of this market.
SocGen, a safe pair of hands candidate, UniCredit. You could literally hear the sigh of relief from financial market participants. Is it more about who he isn't than who he is?
You know, it's a good question. And you made a good argument for the fact that it basically removes some of the less market-friendly candidates from the scene. So just that on its face, hallelujah, gives you the Bessent bump. But on the other hand, you do have to wonder if the way he plans to reduce the deficit starts to come into focus too. Just how much he starts to shift some of the issuance. I know that this sounds like it's in the weeds, but this is going to be the year where we make auctions great again. And Scott Bessent is going to make sure of it.
You'll get no pushback from me. We've seen some changes under Secretary Janet Yellen, and he's going to pick up from those changes and have to decide what he's going to do about it.
He's been particularly critical of the fact that this Treasury Secretary, Janet Yellen, has focused on issuing short-term paper. The expectation that long-term rates were going to come down pretty dramatically, that this was a very short-term, dare I say, transitory inflation and bump in rates, that has proven to be less so the case. And so now the question is, do you term it out, especially with a steeper yield curve? And that is what a lot of people are really questioning.
This morning, bond yields are lower across the curve. Coming up this hour, over the next 60 minutes, we'll catch up with David Bianco of DWS, with stocks on a 5-day winning streak, about to become day 6. We'll speak to Henrietta Treyz of Veda Partners on Trump's Treasury Secretary pick, Scott Bessent, and Clint Henderson from the Points Guy, as millions of Americans prepare for Thanksgiving travel. We begin this hour with stocks higher and bond yields lower as markets applaud President-elect Donald Trump's Treasury pick, Scott Bessent, widely hailed as a stabilizing force for both markets and the economy. David Bianco of DWS looking ahead to next year and writing this line: while a recession is not the base case, risks of overheating and macroeconomic uncertainty remain. David joins us now for more. David, good morning.
Good morning.
Let's talk about that risk of overheating. How very real is that risk for next year?
Well, the economy likely stays strong. I don't think it accelerates because things have been good, and it probably stays at about 2.5% GDP growth. It's inflation being sticky, particularly because of services. That's a risk. So that's perhaps an overheating risk. The other thing is excessive fiscal spending. Now, that's why with Bessent, markets, not just markets, the equity side has been very excited about Trump ever since the win, but this is good news for the bond market. The Secretary of Treasury to come is concerned about the deficit, so that's welcome news. And the message of 333, that's good messaging so far.
So let's get to the 333. 3% growth,
Right.
3% deficit, and I think also it's 3 million barrels a day of oil equivalents, not just oil equivalents, and I think that's a really important point. Do you think that can be met? Do you think that can be achieved?
Right, so 3% real GDP growth is within reach for the U.S. economy with the right balance of of things like tariffs versus deregulation and lower taxes. 3 million barrels over a few years' time, additional to the about 14 million. I would argue that's well within reach, but that would hurt profits, but it's within reach. Now, the 3% deficit, that's out of reach. But I'm glad he's reaching for it and pointing to it, and I think the bond market's excited to hear Secretary of Treasury being concerned about these deficits.
How do you translate ideas and a muddied set of signals from some of the cabinet members who have gotten selected? Scott Bessent catering to the market-friendly crowd, others catering to the vaccine skeptic crowd, others possibly talking about ripping up the Justice Department. How do you put this together to understand whether you need to change your forecast for next year, whether Washington is just going to basically tamp down any extremes and keep things the way they are?
Well, it's still early on. We're still learning so much about these policies, but I'm a markets guy. Bessent's a markets person, so we're feeling good today. But this is an environment where who's to say where these policies are going to go and the right mix and balance of them and how other countries in the world respond to our policies, particularly things like tariffs. It's still a risky geopolitical world, so on one hand, oil prices might go down because of domestic supply, but that's still under geopolitical threat. So our forecasts need to be flexible, and markets are likely going to be volatile over the coming year, but probably still upward.
Was this Treasury Secretary pick, though, really crucial when it comes to pinning the Treasury market in particular, sort of pinning bond yields with somebody at the helm who is going to be very trained on what exactly the markets say?
Well, the candidates were all good candidates. So, I don't think there was alarm in this area, but I do think that this is a selection that people like myself say, this makes sense. This is a thoughtful person and experience with markets. And one of the things that Secretary of Treasury does is help deal with problems, particularly problems in markets, problems with funding. Keeping confidence in the U.S. bond market is an important thing. So right person for the job.
He's been very critical of Secretary Yellen in terms of when it comes to the front end and these bond auctions. Do you think he will push that out to longer dated debt?
If you go back a couple of years ago, a few years ago, when 10-year Treasury yields were where they were, 1%, everybody has to wonder, why didn't you take more advantage of that? Why didn't you do what mortgage borrowers did? But that's hindsight. And from here, I think the key is making sure that efforts are made to bring the deficit down. It'll probably be 7 to 8% next year, but bring it down. I think of the deficit as almost like a very high PE multiple on a stock. And the only way to keep markets calm about that is deliver growth. So that's why I think delivering growth and that 3% on real GDP growth is also an important part of that three-point strategy.
That three-point strategy, though, and you said that the one thing he don't think he's going to be able to accomplish is cutting the deficit by 3%. But he says by
down to 3%.
Yeah, by 2028, though, if you were to get a deficit reduction by 2 to 3%, how long do you think it would take?
To get the deficit all the way down to 3% under the entitlements that we have, it's very unlikely. But let's
ever.
It's unlikely, in my view. If it's achieved over a handful of years or within the next 4 years,
David, what's
Bessent and Hamilton will go down in history as great Secretary of Treasury.
This administration's running 7% deficits at a time when unemployment's close to 4 and GDP is really robust. The idea that we can get down to 3 anytime soon is a worthy goal. But is it achievable?
Yeah, well, and this is the reason why people are skeptical of it. Whether someone's going to actually try to achieve it is also another question. What is your most contrarian call going into next year, given that a lot of the goals to reduce the deficit and also to keep growth at 3% seem unattainable?
Yeah, being contrarian or even being skeptical has not been very useful the past few years. So what I look for are where are good fundamentals still at a price that I won't bicker with. And I would say for the coming year that's still financials. I wouldn't bicker with those valuations, particularly for big banks. Healthcare is an area that I think has still been overlooked for a long time because of so much excitement in technology and digital, but very good earnings growth there. Great long-term prospects, intangible assets, innovation, very on-demanding valuation. So healthcare, financials, and capital goods companies, that's what I like. So one of the things is that more oil, perhaps lower oil prices, but it's good for everything combustion, whether it's oil services or oil refiners, but also diesel engines, natural gas turbines, and jet engines, things like that.
Healthcare stocks have actually been down since the election because of some of the picks and some of the questions around how these departments are going to be overhauled. Do you lean into that at all, or do you basically see it as an opportunity?
We see it as an opportunity. I mean, the healthcare sector has generated really good earnings growth through bigger challenges than this, including already the negotiated drug prices. Now, we know that with a Republican sweep, they'll probably make some changes to some of these policies, but healthcare spending is going up, and the innovation that we see at most medicine makers and even medical device makers, we're encouraged with that, and the valuations are undemanding.
Hey, David, it's good to see you, and see you in person as well. Thank you. David Bianco there of DWS. Slightly distracted around the table in the last few moments from Macy's numbers. The numbers themselves, absolute snooze relative to the headline elsewhere. Allow me to share this quote with you that comes from the company this morning. The company identified that a single employee with responsibility for small package delivery expense accounting intentionally made erroneous accounting entries to hide approximately $132 to $154 million of cumulative delivery expenses from the fourth quarter of 2021 through fiscal quarter ending November 2nd, 2024. Needless to say, there is another line here. The individual who engaged in this conduct is no longer employed by the company. Shocking.
It is shocking. It's the reason why they're delaying their third quarter earnings call until they finish the independent investigation, the internal investigation of what happened. To put this into perspective, Macy's recognized about $4.36 billion of delivery expenses. So this isn't necessarily accounting for a significant portion necessarily, but it isn't necessarily small. And it raises a lot of questions about why someone would intentionally hide more than $100 million of it raises, what are delivery expenses? Is it basically when you ship and get it returned? Are they taking it? A lot of questions here.
I think we've got a ton of questions and not many answers at the moment. I can tell you what the stock is doing. Macy's is lower by a little more than 2%. Any more headlines on that, we'll share them with you. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. A DHL cargo plane flying from Germany to Lithuania crashing close to Vilnius Airport. Police reporting one crew member was killed and 3 others were injured. The Boeing 737-400 was attempting an emergency landing when it crashed. An investigation is underway to determine the cause. Goldman Sachs is eyeing a year-end rally in the S&P 500. Managing trader Scott Rubner saying the index could hit 6,200 by the end of the year, with euphoria accelerating across equities and crypto. Rubner also pointing to increasing demand for buybacks and other typical year-end trends. And finally, according to AAA, a record-breaking 80 million people will be traveling for Thanksgiving this year. Lower gas prices may influence Americans to hit the road. The national average hitting 3.06 a gallon as of yesterday, and it could fall below $3 by Thanksgiving. That would be good news.
Yeah, although I have to say, I'm Googling right now, worst Thanksgiving travel days. I'm trying to figure out when to drive. It's sort of this art, when to figure out.
Thursday morning? I thought Thursday morning is the best time to go.
I don't know. Is that really what okay, is that your prescription? You're going to tell everybody?
I've done a Thursday morning flight before.
You think flights are good then?
That was a good flight.
Okay.
Super quiet.
So Wednesday, terrible. Don't do it.
I don't think I've ever done a Wednesday.
Okay.
I have.
Right. That's awful. Okay, all right. I just am trying to game it out. But what about from driving? Do some research.
I can do some research for you.
Thank
in a
you.
commercial
I appreciate
break.
it.
I would imagine Thursday mornings are pretty decent.
All right. Okay, good.
For what it's worth.
I'll check it out.
Up next on a program, a safe pair of hands.
It's not a bad news scenario, definitely, because with Trump's appointments, it could have been somebody who was very pro-tariffs, very much cutting taxes, but no offsetting fiscal discipline. Those were the worries that Wall Street had.
That conversation up next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures on the S&P 500 firm ahead by 0.5%. A rally in the bond market, yields lower by 3 or 4 basis points. Let's see if this sticks. 436.49. Under surveillance this morning, a safe pair of hands.
It's not a bad news scenario, definitely, because with Trump's appointments, it could have been somebody who was very pro-tariffs, very much cutting taxes, but no offsetting fiscal discipline. Those were the worries that Wall Street had. Based on what we know so far, I think that does alleviate some of those concerns.
So here's the latest this morning. Traders embracing money manager Scott Bessent as Donald Trump's next Treasury Secretary, widely considered to be a safe pair of hands who will prioritise economic and market stability. Henrietta Treyz of Veda Partners looking for Republicans to hit the ground running. As early as January 3rd, investors could learn the deficit appetite of the Republican Party as it prepares to write a massive tax bill to stave off tax hikes on January 1, 2026. In our view, this is the single most important variable in the 2025 tax debate. Henrietta joins us now for more. Henrietta, welcome to the programme. Let's talk about that date, January 3rd. Why January 3rd?
Well, January 3rd is when the next Congress is sworn in. So we'll have all the new members seated. We'll elect a speaker formally in the House. And you can get ready to get down to work with the Budget Committee members and the Senate Finance and House Ways and Means Committee members and start the process of legislating. The first step is the budget, and they can start that as early as January 3rd. And that budget will include the deficit authorization that they're willing to swallow going into next year in the tax bill.
How much do you think that this debt ceiling fight is really going to be a nothing burger this year around because we have Congress and the executive branch all withheld by GOP hands?
Right. Historically, it's a big problem for Republicans to provide the votes on the debt ceiling, specifically in the House. But there are also a number of Senate Republicans who do not vote to increase the debt ceiling. So this is actually a tricky issue. I think the path of difficulty, but least amount of Democratic incurred pain from the Democratic Party is going to be if they include this in a reconciliation bill to pass the tax cut extension along with the debt ceiling at the same time. You all know that you can do a debt ceiling increase with only 51 votes in the Senate if you attach it to that reconciliation package. So this also has the other political benefit of needing to be done by roughly July. That's the current estimate. If they can get through tax day in April, they'll be able to have functionality under extraordinary measures at the Treasury Department through July. And that is, 6 or 7 months before I expect the tax bill to pass, which would otherwise be December. So the debt ceiling actually serves to potentially pull the tax bill forward to July instead of December.
This is really interesting because as you're talking and you're saying that they're going to actually loop all of this in together, I'm thinking to myself, well, Treasury only has a certain amount of months where they're going to be able to pay America's bills. That means we could potentially see a tax cut, the extension of TCJA, much sooner than people were expecting. What do you think gets in? Because Donald Trump proposed a ton of tax cuts, and obviously not all of them are going to become policy.
Yeah, this is where I really want to see what Scott Bessent does at Treasury. It's easy to think of the Republicans controlling everything, but next year it's really very much going to be the White House versus the House versus the Senate. And Scott Bessent is going to be responsible for trying to drive some of the president's tax agenda, which includes things like eliminating taxes on tips or Social Security. That Social Security component costs $1.8 trillion. So adding that onto the bill at Trump's request is going to make the deficit appetite have to expand in Congress, or it's going to increase the scale of the bill from $4.6 trillion to over $6 trillion. So I really am interested to see what the Treasury Secretary does in terms of prioritizing some of the things that Trump wants in this reconciliation bill that House members have no interest in and Senate members have no interest in.
We always say that personnel is policy, and we finally got the key personnel decision of who's going to run Treasury. With that in mind, how do you see the sequencing of tax cuts versus, say, tariffs?
The tariffs have to come first, not only because the tax bill is going to take all year to write. It's going to be incredibly difficult to get this over the finish line, whether or not they include the debt ceiling. And those fights will start on January 3rd. But I think there's this false impression that somehow this is going to be easy. The tariffs are going to be run by either a trade czar at the White House, USTR, or the Department of Commerce, or a combination of all of those pieces. And the tariffs can start immediately. My expectation is right out of the gate, they labeled China in violation of the Phase 1 trade agreement, and that kicks off a process that roughly by April 6th versus, according to my calculation of the enforcement mechanism in the Phase 1 trade deal, you start to see tariffs increase April, May, June, that time horizon.
Henrietta, we're talking about how the Republican Congress is going to potentially push back against some of Trump's policies. We've seen some of the picks really vetted pretty significantly. Matt Gaetz dropped out in part due to opposition from a key number of senators who are Republicans. How much does this indicate that this Republican Senate in particular is not going to just give a blank check to Donald Trump?
I think that's a great point. And the whip list is growing expansively. So members who are opposed to the tariffs, there's at least 5 to 10 who are willing to come out publicly and say, you know, in my home states of the Dakotas or Iowa, Kevin Cramer, Rand Paul is permanently sort of against tariffs, who are coming out and saying that not on my watch. Then there are others that are incoming senators. I think John Curtis is really interesting to watch, a new senator from Utah, to see how he responds to some of these picks. Members who are up in 2026, Tom Tillis in North Carolina is going to have the most expensive Senate race in the country in 2026 and already is preparing for both a general and a primary campaign. And then you have Susan Collins in Maine, who I think is a distinct possibility could retire, and that would put her, or announce her retirement, and that could put her into a much more Kyrsten Sinema, Joe Manchin-esque place in next cycle.
Henrietta, given all of this, how much are they going to push back against some of these cabinet picks, especially some of the more controversial ones?
Well, I think they're trying to do that preemptively now. You know, Matt Gaetz lasted, less than one Scaramucci is the way that we're saying it in DC. So that kind of thing is happening preemptively. Whether that exists for RFK Jr. or Tulsi Gabbard or Hegseth. I mean, I think there are a lot of members that they're already raising issues with. And all this information is going to come out in the Senate confirmation hearing process. And the more controversial there are, the more it eats into Trump's agenda and day one initiatives and drags out things like the tax bill.
How long will confirmations take? Who do you think will be in place day one?
You usually do the big ones first. So defense, state, treasury, those ones will be done by the end of January. I suspect the president will be inaugurated on the 20th. Some of these names have been inaugurated sworn in by the 26th, for example. So a couple of those will move quickly and the rest will take the remainder of the first quarter.
I'd love to just briefly get your thoughts about the one position that is key to Donald Trump's economic promises, but we don't have a name yet, and that's USTR. What's going on with Ambassador Lighthizer?
Yeah, I mean, I think if Ambassador Lighthizer were to come back at USTR, that's obviously a lateral move. That's where he was last time. I wouldn't be surprised if either his chief of staff or general counsel took over that role. I'm still anticipating something in the range of a trade czar-like component, which oversees commerce, which has authority over Section 232, sanctions, the Bureau of Industry and Security and export control restrictions, and then also the USTR, which is where the Section 301 U.S.-China tariffs are. I think given the import and the scale of tariffs on Trump's economic agenda, on offsetting the cost of the tax bill, on reorganizing the way America faces the world, balance of payments issues with other nations, it makes sense to have a czar. And he's shown a willingness to do that with things like Doge, for example, these sort of ephemeral, not normal, and not necessarily sworn in or cabinet position levels. And I think Ambassador Lighthizer makes sense for a role like that, as he is extraordinarily competent, and it would be a mistake to leave him on the sidelines going into next year.
Henrietta, appreciate your time, as always. Henrietta Treyz there of Veda Partners on the latest. When I think of tariff man, I don't think Donald Trump. I think Lighthizer. That's the guy I think of, and still waiting to see what position he has, if any at all, in this administration.
Well, it's interesting because Howard Lutnick got Commerce, where 232 tariffs lives. 301 lives in USTR. When you talk to people in Washington, D.C., whether they like tariffs or not, whether they like Bob Lighthizer or not, they say no one knows trade and the legality of trade like Ambassador Lighthizer. It'll be very interesting to see whether or not he comes back in Trump 2.0, because he was monumental when it came to the first iteration of the Trump administration.
We've got an incomplete picture at the moment. I think we all agree on that. We've got part of the picture in Scott Bessent this morning, but we still need to wait to see who's going to be the NEC director as well, to really complete the picture of what economic policy is and where the emphasis will be.
The picture that we have gotten is a team of rivals, and some of the early reports about what goes on in those rooms consists of a lot of yelling and name-calling. And I have to imagine, on one hand, it's sort of bringing it back to the old parliamentary days of screaming at each other to try to hash out policy. And when is that actually a positive thing, to try to hash out policies that can work and actually achieve some goals?
It works so well in the United Kingdom. What are you talking about? Everyone's shouting at each other. They want to see more of this.
Bring back PMQs.
Right?
Totally.
I'd love to see that. Coming up on the programme, Clint Henderson of The Points Guy as the holiday travel season begins. Two hours away from the opening bell, equity futures with a little bit of a lift. That lift fades, though. That's worth pointing out. On the S&P, we're still up by 0.4%, off session highs on the Russell. Still robust gain this morning of 0.2%. 0.8% on the small caps. With your morning movers, let's cross over to Manus Cranny for more. Good morning, Manus.
Jonathan, good morning. When it comes to squeezing the return on your insurance capital, Blackstone does a deal with EQT. Now, what is the deal? Blackstone gets their hands on cash flow from a pipeline deal. They're going to spend $3.5 billion on natural gas pipelines. It's a joint venture with EQT. What does EQT get? They have a $9 billion debt pile. They need to pay down debt. They need to retain their investment grade rating at the moment. So for them, it's all about pay down the debt. For Blackstone, it is about generating $750 million per annum between now and 2029 on your insurance capital. So that's the alpha here. Just think back to Intel and Apollo. You're possibly going to see more of these deals. Macy's, an erroneous accounting issue. An employee hid $132 million to $154 million in delivery expenses. Why is the question that goes through my mind. Now, we're down 3.5% at the moment. It has been a little bit worse. They're having an independent investigation, forensic analysis into this. They've actually delayed the official release of their results. But for the third quarter, they've told us sales are down 2.4%. Same store sales, a little bit lighter than the market had expected, lighter on that, but an accounting irregularity. Quick snapshot again of what's going on with Tesla. Up 2% this morning. UBS have a no doubt. They've raised the price target to $226 from $197, but they still have a sell rating on this. They say you have an exuberance, you have an animal spirits in this price of this stock at the moment. We put on $350 billion since the election. And over the weekend, Elon's still promising full self-driving, but offering more discounts, Jonathan, in China, over $1,300. And at the same time, you've still got your 0% financing on some of those models. Good morning.
Manus Cranny, good morning. We'll see you again in about 60 minutes' time with some more movers going into the opening bell. Under surveillance this morning, President-elect Donald Trump making his pick for Treasury Secretary. Hedge fund manager Scott Bessent. Bessent will have a busy agenda, already telling the Wall Street Journal that Trump's proposed tax cuts are one of his first priorities. BMO's Ian Lingon just publishing moments ago, calling this bond market rally this morning the Bessent effect and celebrating another adult in the room.
It's not as good. Bessent bump is better. I got to be honest. Like, that actually works. And kudos to you for coming up with it over the weekend. Honestly, to me, this highlights the key question. How long will this stick? Will the Bessent effect or the Bessent bump, let's make this happen, really last in the bond market at a time when he has proven to be a real, I don't want to say fiscal hawk, but at least disciplined in his rhetoric, and that I think is giving people comfort.
And he cares about the deficit, unlike others who just throw ideas at the wall and want to increase fiscal spending. Stanley Druckenmiller obviously worked so closely with Scott Bessent when they were both at George Soros, put on some of the most famous trades in the world. And for Scott, a lot of that was looking at the micro. He says the micro leads the macro. Say it was in England, looking at the housing market and why they made this massive bet on the pound. Stanley Druckenmiller says this: he's the only guy I know who's not only a market participant, but very fluent and comfortable in academic circles. The one criticism about Bessent, or potentially hurdle, is going to be dealing with Washington speak, how slow things work, and potentially being comfortable in those academic circles is going to help him.
Literally the most well-known macro trade of all time, was breaking the Bank of England. And it always frustrates me that Soros gets all the celebration and the hand clapping, and he becomes famous for that, when really it's Druckenmiller and beneath him Bessent that really come up with this trade at the firm.
You can't underemphasize just how long he has studied these macro trends and just how good he is at it. Here's the question, and really to me, I have to go back to this quote from his event in June. We are going to have to have some kind of a grand global economic reordering. He has studied it. He wants to be part of it. What is that grand economic reordering that a lot of people are talking about? And exactly what is his vision for it? And that, I think, is a key question right now.
I can tell you this, the tariffs are part of it. Here's the latest on that front. Look at where the Apple CEO, Tim Cook, is. Visiting China for the third time this year as officials in Beijing prepare to meet with top global CEOs. Companies strategizing around Trump's threat of 60% tariffs on Chinese goods. Trade disruption top of the agenda for Apple, which makes the majority of its iPhones in China.
So what's so interesting is Tim Cook is a stealth diplomat, and not just in China. I think this is his third visit at least this year. But this morning, front page of the Wall Street Journal is how he dealt with the personality of Donald Trump. And Trump says it himself in 2019. That's why he's a great executive, because he calls and others don't. Tim Cook got a lot of what he needed in terms of carve-outs during Trump 1.0. And it was because he went in with an ask and focused on that specific ask, tried to avoid the president from weaving all over the place and just got to the ask he needed, and he was successful. Can he be successful this time around when we've had the likes of Howard Lutnick come on the show and say there's going to be no carve-outs for anyone?
I think it's fair to say they're all calling now, aren't they?
Yeah, they're calling now and they're saying, find me someone who can make an iPhone. Honestly, find me someone who can actually do it the way that they can do it at Foxconn, whether it's in India or anywhere else, because I'm still looking.
Apple right now up by 0.4% in the pre-market. Let's just finish on this story. US officials saying Israel is potentially just days away from a ceasefire deal with Hezbollah. The Israeli ambassador to the United States, Michael Herzog, saying a deal could happen, quote, within days. Israel continuing strikes on Beirut overnight after Hezbollah fired 250 rockets in northern Israeli territory.
So this is interesting because this would mean that a deal would be a 60-day suspension of hostilities. One of the issues that still remains in terms of the Israelis is they want to be able to have this right, reserve this right. If Hezbollah continues hostilities, then that deal just evaporates. The 60 days is interesting because we are dealing with a lame duck president. And basically what he wants to do is at least get a ceasefire in Hezbollah, open the door, potentially, that ceasefire to maybe something in Gaza and a hostage release before he exits the White House.
That's the latest on the Middle East. Let's turn to travel, holiday travel. Nearly 80 million Americans expected to travel at least 50 miles this Thanksgiving. Clint Henderson of The Points Guy writing that this year, quote, travelers have lots to say on price versus convenience. Clint joins us now for more. Clint, good morning.
Good morning.
Can we just clean this up very quickly? Best day to travel. Which day is it?
Okay, so not Tuesday, Wednesday, or Sunday after Thanksgiving.
Thursday morning.
Thursday morning is perfect. Actually, if you travel on the holiday, you're going to have the least crowds. It'll also be the cheapest flights.
Is that both air travel and driving?
Yeah, actually driving too.
Have we settled that for you?
Okay, a round of applause. Good job. Thank you. I'm screwed, if I can say that. Anyway, I will just say this. There is this question, price versus convenience. So what's the verdict?
So it's interesting. We polled with the Harris poll some of our readers and travelers, and they said 50% said price. So price wins overall. But a lot of people are traveling. A lot of people are worried about things. So the poll results were very interesting for us. People are willing to use their points to get a deal and their miles and that kind of thing.
All I can say is that the deals that I'm getting are worse and worse with points. So can you please work on that? Because it's really annoying. Yeah. It's sort of, they're becoming meaningless. They're becoming like the Argentinian peso. Sorry.
We were talking a little bit about Aeroplan, this Air Canada program. You got to start finding these outside the U.S. programs. Air France, KLM, Flying Blue. That's where you find value these days.
I imagine if you didn't book for Thanksgiving, you're, to Lisa's point, screwed this week. When was the best time to have booked for Thanksgiving? And then potentially, are we too late if you haven't booked for Christmas?
So here's the deal with Christmas. Right now, every day from now until Christmas, it's going to get more expensive. So while we're past the sweet spots for both Thanksgiving and Christmas, you really wanted to have booked about a month ago. We say book Christmas by Halloween and try to book Thanksgiving a little bit earlier than that. But I will say every day you wait from now on is going to be more expensive. But here's where points and miles come in, because if you've got a stash of points and miles, the best value you're going to get for those points and miles is when cash fares are really expensive. Now, the other thing we found with a company called PointsPath is that you're going to get less value per point generally for holiday travel. But if you're looking at a $2,000 flight, and you can use points to do that, then you're coming out ahead.
So who's giving the best deals?
So right now, we're seeing cash deals are really the best. So we do deals every single day at the Points Guy. It's one of my coverage areas. And I find regularly flights to Europe under $500 round trip, which is pretty good. The one area of the world that's expensive right now is Asia. A lot of people want to go to Japan especially. But the US dollar is super strong, so that helps ease the burden of higher airfare. But if you wanted to go Hawaii during the pandemic, out of the pandemic, or Florida, or even Las Vegas, those places are much cheaper now than they were 2 years ago when that surge of travel demand happened.
I love that we all had this revenge travel that went in waves and in tandem, and sort of it's rolling from one part of the world to the next.
Absolutely.
I'm just wondering how much of your time you spend and feel like kind of a credit card analyst more than even a travel specialist at a time where airplanes are increasingly just apparatuses of the credit card companies.
So it's really interesting. I got into this hobby. I was a TV news person. I got into miles and points because of credit cards. So my credit cards were my entry point. But to your point, points inflation is a real thing, and we've seen it happen, but there are sweet spots everywhere. You just have to do a little bit more research. And that's why my company where I work, it's such a fun job for me because I get to find those 50,000 point business class seats to Paris.
Do you find them at one firm more than the others?
As far as which credit card?
Finding the best seats.
So
finding the best deals. Do they appear at one company more than maybe they do at others?
Right now, Air Canada Aeroplan, Air France Flying Blue, you can find some insane deals. But I still find deals, American Airlines, Advantage Miles, I still find a lot of deals. You just have to be so flexible these days. You can't say, like I was just looking for flights from Australia.
Sure.
$350,000, 350,000 points one way in business class. I'm not going to pay that. There's no way.
No,
so what I'm going to do is I'm going to time my trip around when I can find the cheapest deal. So you just have to be a little bit more proactive these days. Knowledge is power.
Let's talk about experience.
Yeah.
There's a big business audience watching and listening right now.
Yeah.
Who's got the best experience in your mind out of the three big carriers in the United States?
So Delta is certainly charging a premium because they are sort of building themselves as a premium airline.
These people are expensing it. Don't worry about price.
So I would say Delta and United are fighting it out. American has had some struggles, and I think the value, though, in the program is still with American.
There's also credit card inflation in terms of the number of credit cards that are trying to get in on this. How do you decide when it's worthwhile versus if you've got to pay $40,000 in bills before you get any benefit?
Right.
Is it really worth it?
So there are a lot of credit card sign-up bonuses out there that you don't have to pay anything for. Barclays has an Aviator card, which is American miles. You get 60,000 miles for signing up and just paying the annual fee. So it's pretty remarkable. There's still plenty of sign-up bonuses out there that don't have huge amounts of spend requirements. But yeah, if you want to be the top tier and you want to have all the privileges, you've got to spend a lot of money these days.
Lisa asked you before about price or convenience, and you said everyone's going for convenience. Is that just because it's Thanksgiving and it's holidays and it's stressful? Do most times you see people actually really lean into wanting to get the best price?
Yes. So actually the consumer is very sensitive to price. And I think one of the reasons prices have come down slightly for airfare is because the airlines got a little ahead of themselves on some of the pricing, especially out of the pandemic when they could. Everyone wanted to travel, so they would pay anything. I think people have rationalized their spending a little bit more on travel. So you've seen a return to normal along with capacity increases from the airlines. So we're seeing price normalization, I would say, and the consumer is always the most sensitive to price.
Can you reveal the concierge key secret on air, the actual threshold? So you have to hit at American Airlines to get treated really well.
It depends on what hub city you're flying from. So if you're in one of the hub captive cities like Dallas, they're probably not going to invite you to be a concierge key, even if you spend the magical $60,000 to $80,000 a year on airline tickets.
Just on tickets?
Just on tickets.
So if I pretend that I live somewhere other than Dallas, I've got a better chance?
Much better chance. If you live at a slightly off hub city, focus city, somewhere where they're trying to build up their business, they're more likely to invite you. But the people that are spending $60,000, $80,000 on airline tickets, they don't need upgrades. So why are they rewarded the most? It's not fair to me.
I agree. It's not fair at all. Thank you, sir. They get to board first. I think that's what it's all about, right? Concierge key, get to board first.
Yes, they do. Ahead of people in wheelchairs.
Pulled on ahead of time. They do. Yes, they do. Yes, they do.
Yeah, what is that called? Gate lice? The people who try to
people who pretend.
The
American
people who pretend.
is actually combating
I know.
Right now, this beeping noise.
I love this. Yeah, basically, if you go to board with Group 1 and you don't have a Group 1.
I see those people at the gate all the time.
Yes,
I see them at the gate.
I'm one of those people.
And those people that fly business class for the first time and assume they're boarding first. I know those people too, yeah. Clint, good to see you. Clint Henderson, the Points guy. Thank you, sir. Let's get you an update on stories elsewhere. Let's get you some news. Here's your Bloomberg brief. Macy's is delaying its third quarter earnings due to an investigation. The company saying a single employee responsible for small package delivery expense accounting intentionally made erroneous entries to hide about $132 to $154 million of expenses. Macy's saying the employee no longer works for the company. Their stock is down 2.5%. The founding family behind 7-Eleven operator 7 & I has hired SMBC to advise its nearly $60 billion proposal to take its business private. Nearly all of Japan's top banks have jockeyed for a place in what's poised to be the country's biggest ever buyout deal. And finally, Andy Murray is returning to the tennis court, this time to coach his longtime rival Novak Djokovic. Murray, who retired from professional tennis in August, told the Associated Press he will help Djokovic prepare for the 2025 Australian Open. Very cool.
Wow, that's so interesting because he dropped out from injuries and a whole host of things. He's a new father, but he can't stay away. And how could he? To go back to coach his rival, it's a good movie. I think
a comeback for early 2025 and looking forward to it. Up next on the programme, the bond market finding stability.
I think this nomination is really good news in that it takes away some of those tail risks and really sets path back for the US economy onto something which is really, really strong growth, but also good news for the rest of the world too.
Yih-Tennant of Columbia Threadneedle up next. Welcome to the programme. Here's a snapshot of the price action for you. I'll get my words out. Equities right now in the S&P up by 0.5%. Remember to speak. Yields are lower by 5 basis points on a 10-year 435. And the surveillance this morning, the bond market finding stability.
Over the last week or two, what we've seen is an unwinding a little bit of the Trump trade, but more because of concerns around some of the extremes of the policies. I think this nomination is really good news in that it takes away some of those tail risks and really sets path back for the US economy onto something which is really, really strong growth, but also good news for the rest of the world too.
It's the latest this morning. The bond market showing signs of steadying following Scott Bessent's appointment to run Treasury. Yih-Tennant of Columbia Threadneedle writing, with inflation cooling and the Federal Reserve transitioning from rate hikes to a cycle of rate cuts, bonds are poised to perform well in 2025. Gene joins us now for more. Gene, welcome to the programme, sir. Let's talk about your call for next year on the Federal Reserve, because it's very, very different to what I'm going to hear from Matt Lazzetti of Deutsche Bank tomorrow morning. Matt Lazzetti has got the Fed on hold through the whole of 2025, and one cut may be in December, next month, this year. Then he thinks they might be done. Why do you think they're going down to 3 and maybe even lower through next year?
Well, good morning, John. Thank you. I think the difference here is the Fed has to disprove 1996. 1996 is that example when the Fed, after a period of having raised rates aggressively, started reducing rates in 1995, did so by 0.75 percentage point, which is what we've seen so far, but then they stopped to the market's surprise. But why did they stop? Was it inflation reemerging? Actually, no, it wasn't. It was really a reacceleration in the labor market. And I think to believe that the Fed is going to stabilize rates near current levels or maybe with one more cut, you have to believe that that labor market is going to reaccelerate again. It's possible, but the truth is we just haven't seen it yet.
Gene, do you believe then that the market has gotten ahead of itself in pricing in that, frankly, the election is going to materially change the economic outlook for next year?
Look, policies do have real outcomes, but I do think, Lisa, that the market's gotten ahead of itself a little bit. We have seen this administration before, but we also have to remember that the starting point is different and the starting point matters. We had negative real interest rates in Trump 1.0 in 2016, and now we're starting at a much higher place in terms of interest rates, and we're in the unique position that we haven't seen many times in the last decade, where interest rates are actually above the path that the Fed itself is forecasting. Even if that forecast path moves up a little bit, I don't think it'll structurally change in this environment, given how much inflation has declined.
Gene, this is almost contrarian, given some of what we've heard and what we're going to be hearing from Matt Lazzetti tomorrow in terms of the Fed's path and what that does for benchmark rates across the curve. I'm just wondering how much conviction there is, how much you're actually seeing and going into longer-term treasuries with both fists at a time when other people are saying, maybe Europe.
I wouldn't say going in with both fists, Lisa, but I do believe that there's value in high-quality bonds, and I think it's a very easy thing to sit back and sort of lazily say that interest rates have to be heading higher because inflation is going to be heading higher due to tariffs, for instance. But I think if we look at the Treasury Secretary pick this morning, I think it relates very well to what I would classify as the two scoreboards that the administration is going to be looking at. And those are the equity market and the inflation rate, because frankly, inflation is part of the thesis that helped this administration get elected. So I don't think they're going to let inflation run away. And I think in that environment, I think it's very likely that we're likely to continue towards lower neutral interest rates towards that 3% area.
When you look at how the market is reacting to Scott Bessent, is it because he's a known quantity, or it's because they think this is a steady pair of hands and it's not someone that is on a different list that no one was expecting?
I think it might be the latter. I think, it's viewed that he's a market practitioner, and in the eyes of the markets, that's a comforting signal. I think there were other potentially alarmist characters that were considered. So I think in this sense, the markets are comforted for now. The truth is we don't really know. We imagine that someone to take this seat is signing up to a pretty aggressive tariff policy, but hopefully one that's a little bit more targeted than broad-based.
Do you think with a name like that, when you say broad-based, that tariffs then will be a negotiating tool and not a blanket response?
I suspect so. I mean, you're certainly going to hear the headlines every single day. But again, we had material tariff conversation in the Trump 1.0 administration. We did see a material decline in China's share of U.S. imports. And we've seen offsetting growth across not just one, but a variety of countries, including Mexico, Canada, and others. So I think that will gradually continue to be the case. But it remains to be seen exactly how broad-based they are in terms of that initial rifle shot.
One company after another has come out, investment company, and said they prefer credit to duration at a time where it seems like the economy is going to be pretty good in the United States, and there are questions around the duration component. Would you reverse that? Are you more confident about duration, both in the U.S. as well as in Europe, than, say, credit, which already has been bid up pretty considerably?
Yeah, I'd probably take the other side, Lisa, to be honest with you. I think it's easy to say, oh, I feel good about credit from a fundamental standpoint. We would agree there. Leverage is in a very healthy place, particularly if we look at the investment grade universe, both from a margin and a leverage perspective. Those are each about the healthiest that they've been in the last decade. But the question is, what are you going to generate from an excess return perspective when credit is at the most expensive it's been in more than 2 decades? And really from a duration or a real interest rate standpoint, it's the other way. All of the indicators are leaning on the cheap side rather than the expensive side. So I'd be a little bit careful getting too excited on credit. We like the fundamentals, but we rather stay a lot shorter and more defensive in the credit markets.
Hey, Gene, good to hear from you. As always, buddy, have a wonderful Thanksgiving. Gene Tannuzzo there of Columbia Threadneedle. Reminds me of a quote from Goldman Sachs and Lofty Karui. Shared it with you last week. It's worth repeating. Barring a sell-off between now and year-end, investors will likely enter 2025 with the most severe valuation constraints in more than 2 decades in credit.
Yeah, I mean, basically, you're looking at spreads that in high-yield land is basically the tightest going back to 2007. So you're talking about a price-to-perfection type of moment at a time where there's some real questions around what higher rates for longer would actually do to profiles that haven't yet been tested because the debt has really been termed out.
Gene was talking about the differences between now and 2016 when he was talking about why he thinks rates go lower. And I was thinking, isn't that an argument for rates to be going higher? Because the big difference between now and 2016 is this is no longer a market crying out for fiscal stimulus. In fact, quite the opposite, given the fact that we're looking at an economy with unemployment around 4%, GDP is still pretty robust, and the budget deficit's 7%.
The one fly in the ointment is if they have to reduce the deficit, then that's going to become something that constrains growth as well. And that won't necessarily turbocharge things in the same kind of way.
Yield to lower this morning by 5 basis points. Up next on the programme, we'll catch up with Mike Wilson of Morgan Stanley, Adrienne Yih of Barclays, Francis Donald of RBC, and Noel Dixon of State Street from New York. This is Bloomberg.
The U.S. is the only engine of global growth right now.
There's a lot of opportunity here, assuming the economy continues to grow and profits continue to grow.
The Fed always is a key story here.
I think it will take a few more Fed cuts to push the 10-year above 4.5%.
It's actually getting back to normal. And you can see that if you look at overall inflation trends.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell in New York City as we kick off a brand new trading week. A 5-day winning streak on the S&P 500, shaping up for day 6. Equity futures right now on the S&P positive by 0.5%. Outperformance on the small caps. The Russell up by 1 full percentage point, supported by this right here in the bond market. Yields lower across the curve. 2s out to 30s. On 10s we're down 6 basis points at 434. That move right there unlocking some dollar weakness against all of G10. The euro against the US dollar this morning around 105, Lisa, at 104.92.
My favorite is that stocks go up and small caps do well, even when the bond yields were heading higher, simply because it was going to be a pro-growth type of scenario from Donald Trump. Now you have Scott Bessent, who is aware of the deficit and concerned about the deficit. He cares about the deficit, and so people are saying, well, he's going to put some sort of ceiling on how high yields could go, and that, too, is good for some of these caps. So it's basically heads, I win. Tails, you lose.
The markets is really welcoming someone that understands and has a deep knowledge of global financial markets like Scott Bessent, an individual who, alongside some of the top names in investing, put on famous trades of our time. Someone who cares about the deficit. This is going to be the face of Trump's policies. But what is interesting is what Terry Haines talked about, this cabinet of rivals. How much is it going to be the push-pull when it comes to tariffs and when it comes to tax cuts and the sequencing of both those policies?
So missing pieces. National Economic Council Director, 1. US Trade Representative, 2. Where does Bob Lighthizer fit in here over the next few months, if at all?
It's a great question, especially given the fact that Scott Bessent wants to use tariffs as more of a negotiating tool. That's at least what he said, versus Robert Lighthizer, that is, as you said, truly the tariff man. He actually wants to create a greater division between the East and the West.
And does he go to USTR when he would welcome the use of 301 tariffs, or does it become this trade czar, which people have been talking about? But I think it's really interesting that so far, this is an individual, Donald Trump, who ran on the idea that tariffs is a beautiful word and we should be using them. We do not know yet if even Ambassador Lighthizer is going to be entering Trump 2.0.
We've got a lot to discuss this hour. Coming up, Mike Wilson of Morgan Stanley as global markets embrace Trump's Treasury pick. Adrienne Yih of Barclays as a shortened holiday shopping season begins. And Francis Donald of RBC looking ahead to this week's economic data. We begin this hour with stocks higher as the post-election rally picks up steam. Investors welcoming President-elect Donald Trump's Treasury pick, Scott Bessent. Mike Wilson of Morgan Stanley weighing in on the equity outlook, writing, with hard landing risks reduced this fall, the Fed cutting interest rates, business cycle indicators showing signs of life, and the potential for an animal spirits rebound post the election, the path of earnings growth should be upward as we head through 2025. Mike joins us now for more. Mike, good morning.
Good morning.
It's good to see you. How unusually wide are the range of outcomes for 2025 for you and the team?
Well, it's about the same as it was in the mid-year. I mean, we've moved to this sort of view because the outcomes of the election, the economic outcome, rates, policy, et cetera, is also wider. So, we have to take that into account. And we did a pretty good job, I would say, this year of moving that around, meaning as the economic outlook changed through the summer into the fall. I mean, that's really the game now, is just trying to get ahead of these sort of pivots because it's going to remain uncertain. You all were just discussing the new cabinet positions. Yeah, I mean, they don't even know yet. They're going to try to figure this out. That's the challenge. And I think the markets are going to, as usual, trade that. So we're trying to do that as well for clients.
So your message to clients going into 25, be nimble. You've got some sector picks in there.
Yeah.
The overweight you like is financials. The underweight, the sector you don't like, the consumer. Both staples and discretionary. Can we start with the consumer? What's not to like?
Yeah, well, I mean, it's been weak. I mean, the consumer has been softer, and this fits into our sort of, our call we've had for a while, which is that the government has just sort of crowded out a lot of the economy, right? I mean, the low-end, mid-end consumer, low-end, mid-end businesses, quite frankly. So that's something we are now thinking about, right? This changeover, I mean, this is why Trump won. This is why the Republicans won. They want change. Consumers want change. So let's see if they can execute. But that's something that we have a short leash on now on the consumer side. I'd say we're looking to maybe upgrade certain consumer stocks if they can pull off some of these policy challenges that they're going to try to navigate. And look, I think on the financials, we've been overweight financials. It's been a terrific group. And the question there is almost how much further can it go? But look, once again, policy, deregulation, Basel III coming off. I mean, these things are all positive drivers that should continue to help that sector, at least on a relative basis.
Policy challenges and changes for the consumer. What changes would you need to see to upgrade a bigger cohort of those names?
I think that, once again, it's this crowding out thing. So this is a big picture view. But if they can shrink the government size, and by the way, this is going to take years. Okay, this is not going to happen in 6 months. And that's why we're not upgrading consumers yet. But if you're able to shrink the size of the government, kind of get them off the back of small businesses to some degree. You can't. This animal spirits thing is real. And then, of course, if you can get, the rate situation under control, where term premium is balanced with the budget, those are the kinds of things that can actually spur consumer spending, consumer confidence, which has really been in the doldrums.
How much is it also tax policy? Essentially, if people pay fewer taxes, they can go out and spend more on Gucci.
Or anything else. I mean, quite frankly, the consumer's been having a hard time spending money on food. So let's start with that. Let's start with just getting inflation sort of under control. Getting people's confidence about the economy going forward and willingness to sort of look forward and spend on things, invest in things. I think one of the biggest areas that has really underperformed is consumer durables because rates are still too high. The level of rates are still too high. Now, I don't think we're going to be able to see rates come down any faster because of this administration, but over time, I think that's the key. If we can get rates down to a plausible level, wages increase to offset the inflation that's already in the economy, the consumer will fare better.
There are a lot of other questions like tariffs and how that could potentially affect some of these companies. But there's a broader point here, which is that specific sectors are going to respond very differently to policy changes going forward and don't necessarily have the same kind of macroeconomic overlay that they've had in recent years. And I wonder how much you're sort of seeing that play out. And I point to healthcare in particular because it's been one outlier over the past 2 weeks. You've seen it go down some 6% because of the overhaul that clearly is lining up with some of the picks for CMS and HHS. Do you lean into that, or do you see these as opportunities?
Well, there's both. I mean, there's going to be risk here too. I mean, by the way, once again, the markets are very smart about this. They've punished big food companies because of perhaps Bobby Kennedy's appointment. Same thing for pharmaceuticals. So the bad news is sort of already getting priced in that regard. But the positive story in healthcare, quite frankly, is just an efficiency story. It's no different than the government. This is going to take years. If we can make the deployment of healthcare, the delivery of healthcare more efficient, that's going to create great opportunity for certain types of businesses. But this is to come, right? This is why we need to be nimble and think about, okay, it's not all going to happen at once. There's going to be moments of fear, doubt, and uncertainty, and that's going to create the opportunity, we think, through 2025.
You keep coming back to efficiency. Do you think Elon Musk and Vivek Ramaswamy could Dogify the economy?
I think there's a good chance that we can not necessarily cut all the spending they're talking about, but if we can just freeze spending. Remember, the key here is fiscal sustainability, which is just let's grow the government slower than we're growing nominal GDP. If you can get into that position, so Scott Bessent has said, this part of his plan, let's just get the fiscal deficit down to 3%. We're not talking about going to zero, but if we can just get it to 3%, that's in a much more sustainable place, which is one of the reasons why I think the bond market is reacting, at least initially, somewhat positively to this. One of the key negatives or risks that we see in the short term had been term premium. If term premium continued to widen out, that's a real risk for multiples. So I'm encouraged by the reaction initially, but I'm also not confident to say that this is going to be, it's a straight path from here to there.
What do you think the North Star is when all is said and done of this administration? Because you have things like tax cuts, but things like as well as tariffs, which in a blanket response, many economists say could be inflationary, but they ran on getting inflation down. Is that the number one key thing that Trump wants to make sure inflation comes down for Americans to afford groceries? Well,
I think that look, his mandate was prices are too high. There are probably three main issues. Prices are too high, unacceptable. Immigration, we've got to fix that. And then this idea of these never-ending wars and spending money over unnecessarily in many Americans' eyes. So he's going to try and take all three of those. It's kind of an America first policy with the sort of added twist that we're also going to try and redistribute the income in a way that's more taxing people and then distributing it that way is inefficient. If you can somehow reduce taxes and get the income redistributed at the wage level, that's really, really good. I think that would be the goal. Once again, it all comes down to execution.
When you say nimble and being nimble as an investor, are you saying trade frequently? Is this going to be the most active trading year that you can imagine for the team in 2025?
Yeah, I think that's a really good way to put it. I would say we've been more active in that regard, trading the underlying as opposed to focusing so much on the index. We are probably going to be offering more trades for clients. And when I say trade, it's not a day trade. It's 3 to 6 months, rotating around the portfolio in a way that is actually you can do that in size. Right? We're not going to say, hey, do these things that larger clients can't do. But 3 to 6 month trades is a lot faster than sort of a 12-month view.
Do you see the breakdown of correlations that have traditionally held true, whether it's with yields and the effect on stocks and some of the macroeconomic overlays? Are they going to become less relevant as there are these sort of rotating trades, 3 to 6 months that kind of go through sectors and specific names?
No, I think they become more important. I think the macro will always play a role. I do hope and expect perhaps next year that we can see more micro opportunity. And what I mean by that is that because of the economy and the setup, that policy that we've had, by the way, this is not just the last 4 years, this is the last 20 years, this crowding out, right? It's the big get bigger, the have and have not, the K economy that everybody's sort of familiar with. That, to me, is going to be the key. Can we move from sort of a very narrow participation in the economy, both from a consumer and corporate standpoint, to something that's broader? If that happens, that's going to create more micro opportunity, but it doesn't mean you can ignore interest rates, other policy changes, because that's what's going to affect the micro opportunity.
Where does that leave the Mag 7? Some of these dominant companies?
I mean, I think you're already seeing it. It's like there's going to be more winners. It's going to be a separation of winners and losers there too. One thing we know about cycles over time is that the big winners of the last 10 or 20 years are not the big winners of the next 10 or 20 years. And so we've talked about this a lot. We've written about it. Like AI, to me, the big exciting part of AI is not the guys who are building AI today and the picks and shovels who have already won. It's the application layer. Who's going to develop and deliver the solutions that take advantage of this new compute platform to deliver the efficiency for corporate America for consumers, much like email did, or web browsers, or software as a service. I mean, you think about the big winners of the internet, it wasn't the carriers who spent all this money and put it in the ground. It was the companies that built the application layers to build better mousetraps going forward.
You wrote about some of this earlier this year. You said the focus at the moment of the equity market was on the AI enablers, which was the chips companies, the Nvidias of this world. Where are we in that process? Are we moving away from that yet?
Well, we're still in it. I mean, there's still companies are still benefiting, but that's all very narrow too, by the way. There aren't that many beneficiaries of the spend, which has been unusual. It's very different than the 90s where you had hundreds of beneficiaries. So I think we're still in that phase, and we're going to transition to now the adopter phase, like who can actually use this stuff, which so far is only the hyperscalers. Once again, the really exciting part is the ones who can actually take this platform, build applications, and then deliver it to dummies like me and make me more productive, right? Like just the average person to say, I don't need to be a technologist, but I understand how this application works and how it can make me more efficient in doing my job, which is, looking at stocks, in these mass quants of data in a way that I can actually understand and deliver it to clients.
We've known each other a while. I have to say, you sound pretty excited about next year in a way that I've not heard you for a long time.
Yeah, I mean, we're not always, one way. So I would say we've been excited about this for 6 months. It's just now we can kind of see it in a way where we can see a broadening out. We see it in the numbers, right? We've been waiting for this. So in the last 2 quarters, we've actually seen a broadening out of the earnings story for the first time, even before the election outcome. Okay, so this is a 2-step process. It's going to be noisy. Stocks are expensive. Okay, that's something we have to understand. The markets are ahead of this already. Let's not think that we're discovering the light bulb here. Okay, the markets have already done this. So, but yes, I think there's a wider path now, a wider set of opportunities, which to me is more exciting.
You've spent a lot of time speaking to clients over the last few months, I'm sure, about the outlook for 2025. What are they most skeptical about? What's the biggest pushback you get?
Well, valuation has been, I've been skeptical on that, quite frankly. So it's still, people are uncomfortable with the valuation in the equity markets. But then when you think about, what else is there out there? And then you look at the U.S. versus other markets too. So that's probably the biggest one. The second one is just, it still feels unstable. I mean, like geopolitics, the political angst in this country is like not resolved. I mean, there's still this very bifurcated political environment. People's economic situations are very bifurcated. That makes people uncomfortable. So I think that's the part that people it's hard to get uber bullish when you have all these things that are kind of holding you back.
Do you sense that some clients, and of course you're not going to name any, but do you sense that some are finding it difficult to divorce their political bias away from their economic views? Have they learned the lesson of 2016-17?
I mean, most clients are more objective. Investment clients are more objective about that because they have to be, right? Because there's this thing called the price that makes them be objective about the outcome. That doesn't mean they don't hold personal biases. We all do. That's natural. I do think 2016 maybe changed that a bit, but look, we're all forced to perform. And you whether it's a political bias or it's a style bias, you have to navigate that and be flexible.
Just to put a bow on this conversation, the essence of this conversation when you talked about the administration was the real potential for real change. When I asked you about whether some of these clients are skeptical about 2025, are they skeptical about anything in the administration's agenda that you think maybe they should be paying more attention to?
Well, we wrote about this weekend. I mean, there's a tremendous amount of skepticism on whether they can actually streamline the government because it's just, I mean, people have tried this before. This is not like a new idea, right? So it's difficult. I mean, and we all know about these roadblocks that are kind of built into the system that, the appropriations, the way you get the money that have to be spent, the civil liberties laws, which are good laws to protect people's rights on jobs. But it's almost like you're fighting against this giant blob and people are very skeptical that you could beat the blob. And I think that's an area where we need to be a little bit more open-minded. I'm more open-minded about that because this is what the American people want. When I forget about talking to investment clients, when I talk to people on the ground, people look at the government and they say, hey, government does a lot of great things for me, okay? But I have to worry about my job all the time. I have to operate in a different world. Why should they be operating in a different environment? I just think there's opportunity. And this is also potentially liberating for people in the government. There are really good employees in the government, okay? They just play for a bad team. It's like, let's take a good player on a bad team and let's put them on a better team, and then probably you get more productivity out of that person. I think that's exciting. It's a lot of risk. Okay, it's going to be a really messy road.
Yep.
But that to me is interesting.
Looking forward to covering it with you. It's good to see you.
Good to
Mike
see
Wilson there of Morgan Stanley on the latest. Equity futures right now in the S&P higher by 0.5%. With an update on stories elsewhere this morning, here is your Bloomberg brief. The UAE arresting 3 suspects in the murder of Israeli-Moldovan Rabbi Tzvi Gogan, whose body was found Sunday after he was reported missing in Dubai. Israel is reinforcing travel warnings to the UAE. Apple CEO Tim Cook returning to China for at least the 3rd time this year. Cook attending a supplier conference in Beijing. The Apple boss is also expected to join a meeting of foreign CEOs with the Chinese premier. The meeting is expected to address supply and trade issues ahead of the incoming Trump administration. And finally in sports, the Chiefs survived a scare against the Carolina Panthers, holding on for their 10th win in 11 games. Elsewhere, the Eagles dominated the LA Rams on Sunday Night Football behind a franchise record-setting rushing performance from Saquon Barkley. From New York, that is your Bloomberg brief. Up next on the programme, the morning calls, plus Adrienne Yih of Barclays on her top retail pick for 2025. That conversation just around the corner. From New York, this is Bloomberg. The opening bound 1 hour and 10 minutes away. Equity futures right now in the S&P 500 higher by 0.5%. Let's get you some morning calls. First up, UBS raising its price target on Tesla to 226, warning the EV maker's post-election rally has been driven by animal spirits over fundamentals. Stock is up again by 1.8%. Your second call, D.A. Davidson upgrading Procter & Gamble to buy, highlighting greater confidence in China sales. That stock up by about 0.25% this morning. And finally, Oppenheimer adding Target back to its top pick list, pointing to very attractive risk-reward. We rebound on that name by 1.5%. Retailers more broadly preparing for a shorter holiday shopping season after a major earnings week, including Gap, which is seeing wealthier consumers searching for value. Adrienne Yih of Barclays writing this: Gap is our top retail idea for a cyclical recovery into 2025 as it shifts from solidifying operations to growth mode. Adrienne joins us now for more. Welcome to the programme. Let's start with Gap. Can you tell us what you think they're getting right at the moment? What's leading to this big share gain?
So what they're getting right is the value equation for the consumer. So if you look at the retailers that are sort of winning in this environment, it's those who are like Walmart, TJX, the off-pricers, Old Navy in this particular case. And they truly are kind of giving back real value to the consumer. With regard to the Gap brand within, the Gap organization, they're also finally starting to hit their stride on connecting with the consumer. So it's been at least a couple of decades, probably, last time that we saw them do positive comps at the Gap brand was 2011 and 12, when it was kind of the skinny leg craze. And I think part of it is that they're really focused on the fundamentals. They've got they've solidified their store base, the cost basis. And we also, for lack of, other things, they also have a silhouette shift that is a denim-based one, and it's in their favor.
So you talk about creating value, and I think about the sort of pairing that idea, the lowest prices, with style and getting influencers to get wide-legged jeans that look like they're in vogue and get them out to the masses. What does value mean? Who isn't creating value?
Yeah, that's a great question. And we like to separate value versus cheap. So value is price paid for quality received. So when you go to an off-pricer, or even if you go to Old Navy, you think that you're getting, you're paying something, and you don't mind paying $50 for something that you think is probably worth more than that, $75 or $100 even in off-price. But what you do care about is paying, cheap prices for something that you think is worth exactly that or less, right? And that's the huge differentiator here, especially in this environment where CPI, inflation across all these different products is eating away at that wallet. The consumer's really looking for somebody who's going to provide them the ability to stretch their dollar and stretch their wallet.
Adrienne, something that we woke up to this morning was suddenly a renewed focus on shipping costs and how that can come back to bite. And for an e-commerce type of organization, which a lot of these retailers seem to be coming, how important is minimizing shipping costs? How much is that becoming an increasing drag on some of the companies you cover?
So the e-commerce piece of it, exactly that last mile delivery, which you're talking about, we should think about those like wages. They just perpetually go up. Remember, the essence of kind of that shipping is going to be an employee base where their wages are going up, whether it's UPS or FedEx, et cetera, any of these delivery companies. So you can kind of think about that as a permanent inflator. And the way to combat that, frankly, because it's very much a variable expense, is to get ever smarter and ever better about your inventory management, trying to buy and see what demand is and sell at full price. So it's a really, really tough, equation there. But just as on their store side, the store payroll will permanently go up. It's just about operating your entire omni-channel business much more efficiently.
Adrienne, just wanted to finish on this. I know it's not a company under your coverage, so I won't name it by name. We'll just talk about the story in general terms. There's a company this morning where a single employee was responsible for small package delivery expense accounting, intentionally made these massive erroneous entries to hide about $150 million worth of expenses. How unusual is it for something like that to happen at a company like this?
It is, it's a breakdown of the disciplines. It is pretty unusual, frankly. Typically, let's put it into perspective that $150 million is on about $4.3 billion worth of total delivery expenses. So it's a number. It's a real number since 2021, but it's about 3% of their delivery expenses. Not a great look for, said company. But what I will say that there's a lot that goes on. I've been in the retail industry. That P&L has thousands of lines in it and thousands of employees that you have to assume are doing the right thing. And I think that there was a breakdown in this particular instance of the oversight in that department, for sure.
Adrienne, appreciate your views on that story as well. Thanks for being with us. Adrienne Yih there of Barclays. Now, thanked Adrienne. I can, of course, name that company. If you're just joining us, that company is Macy's. Yeah. And it's not a pretty story this morning.
That number that she just said, that's $3 billion of packages to account for about $150 million of shipping costs. That's massive.
132 to 154. I think we've all got a lot of questions and very few answers so far this morning. From New York, good morning. Equity futures near session highs on the S&P 500, higher by 0.5%. The outperformance, as we've discussed all morning, is on the Russell. The small caps higher by 1.1%. With 60 minutes until the cash open with your morning movers, it's Manus Cranny. Morning, Manus.
Jonathan, good morning. Those small caps are on a heck of a run. EQT has the lowest investment grade rating available, BBB. What do you do to protect that and pay down the debt? You've got a whole host of pipelines. You do a joint venture with Blackstone. You charge them $3.5 billion. They get to actually deliver a return on the capital within the insurance business, which is about cash flow. $750 million between now and 2029 comes into the insurance business. EQT gets the money to pay down debt. And that's what you call a perfectly symbiotic deal. Roll it over, have a look at MicroStrategy when it comes to, I suppose, the collation between Bitcoin and this company. We've talked about it many times, but this morning we have a note from Bernstein where they say this company could be on track to hold 4% of the Bitcoin market in a decade. They upped their price target by 42%. Now, they've already been slightly behind here on the curve, but they talk about the capital plans by this company so that they can buy more Bitcoin well ahead of the schedule. And it's not really going to impact the long-term unsecured convertible debt that they're issuing doesn't really hit the balance sheet. So a nice bid from Bernstein on that. You've just talked about Macy's. I'll round it off here. As your last guest said, this is 3% of the overall expenses that we are dealing with. So that's some context for you. An employee hiding between $132 and $154 million of delivery expenses. Why? Why was this person hiding those expenses? We don't have the answers to that. We've got an independent investigation. And the sales come in just a smidge lighter. They've delayed the formal sales results. But sales, same-store sales, Jonathan, down 2.4%. That's just a little bit lighter than the original estimates.
What a crazy story. And a name to watch going into the opening bell. Manus, thanks for that. A busy week of economic data ahead of us, including consumer confidence, Fed minutes, and a core PCE reading. Francis Donald of RBC writing, we have relatively high conviction that the Federal Reserve will cut 2 more times before pausing, though less conviction on the exact meetings. And yet, we don't think the month-to-month meeting outcome matters as much as what happens after the Fed pauses. Francis joins us now for more. Francis, good morning.
Good morning.
What does that little tease mean? What happens after?
Well, it means we're spending a lot more time thinking about what happens by the end of 2025 and into 2026 rather than the typical economist game of is it a December pause or not? And I have to tell you, we're really starting to actively think about, is there a scenario that leads to hikes by the end of 2025? We've gone from how many cuts is it going to be to two-sided risk on the Fed forecast. That's a big change in the way we have to think about things. I'm going to spend a lot more time talking to my clients about preparing for that possibility, stress testing that scenario, which very few are really actively considering right now, than I will telling them it'll be a December pause and a January hike.
Let's spend some time doing that right now.
Sure.
Thresholds, bars. How high is the bar to resume hiking?
I don't know that it's as high as many might think it is. Remember, inflation is still relatively sticky, and we have some inflationary shocks coming down. We have tariffs that might be coming through. That matters. And more important than tariffs, immigration policy could be really important to the growth outlook and to the inflation one. I actually think immigration will matter more than tariffs over the next 3 years, and yet we don't spend as much time talking about that. Think really critically. We have to recognize we can't have our cake and eat it too. We're not going to get a strong, resilient, roaring 20s economy and rate cuts. The idea that we get back to 3% and yet we still have very strong growth and unemployment rate remains low, that's not a reality that's going to exist in 2025. So pick your lane. There is still a possibility that the U.S. economy doesn't make it to this soft landing. We still need small businesses and low-income consumers to feel a little bit better, to feel the benefits of those rate cuts. That still exists. But the tails are fat in the forecast. There is significant uncertainty. Now is the time to prepare for multiple eventualities, more so than even 6 months ago.
I want to dig into that whole immigration as more important than potentially trade policy at a time where a lot of people have thought wage inflation is kind of on the wane. That's not going to be the main pressure. Implicit in your statement is that wage inflation could be the driver that gets the Fed to raise rates once again at the end of 2025. Can you walk through how that looks, what the thresholds are that gets us there?
Sure. So tariffs, yes, we have to do a lot of work. Tariffs are sort of a nuisance for economists to have to calculate. But what really keeps us up at night is labor supply shortages. So tariffs, price level shock occurs one time, falls out of the inflation statistics. But the more nefarious inflation comes from not having enough workers. That's a type of inflation that scared policymakers after COVID. So if we see a drop in the labor supply, and remember, this is happening in the context of record retirements. We don't talk about that. Why not? We have 3 retirees for every 1 new entrant looking for work in this labor market. It isn't a long-term issue. It's a 2025 issue that's changing and mechanically impacting things like the unemployment rate and wages. So if we add on that we're going to see mass deportations that either in literal terms or that we don't see beneath the data make wages rise, that's a more difficult type of wage pressure, it's the most difficult type of inflation that the Fed is going to have to respond to, whereas tariffs, it's more of a one-off.
So can you put some numbers around this even? Because I've been looking back at deportations, and they're not unheard of. I think there were some 1.5 million people deported under the first Trump regime, and there's also been some 1.5 million people, or even 3 million, that were deported under Biden. I mean, I'm just wondering how many would have to be deported in order to really create a dent?
Well, every single one will matter in an environment where labor supply is going to be a critical issue for 2025. But Lisa, it's like all other policies. We don't know the scale, scope, or timing on a vast array of policies coming through, and their sequencing is going to matter a lot. What we do know is the direction of these policies. We know the direction is towards protectionism. The direction is towards deportation. And so we have to calculate into our outlook the risk that we actually see greater emphasis on labor shortages, greater prices via the tariffs that are coming through. That's what we're contending with at this point, is sequencing, because that matters a lot for 2025, and size.
So how much tension do you see potentially from a Trump White House and a Federal Reserve if they are even thinking about hiking rates?
Well, this is the big challenge that has existed over the past several months, is we have pro-cyclical fiscal policy, and then we have monetary policy that's been trying to ease, and they have been at heads with each other. But if the economy is very strong, we should see some pullback in fiscal activity. We should see some fiscal constraint, and we should see higher interest rates. So I don't see so much of a tension if the economy is doing well. What will be more problematic is if the economy starts to weaken at this point, and the Fed is nervous about that and wants to cut, but can't because of excess fiscal spending, or we haven't seen that pullback. For me, 2025 is a really critical year. We're walking that tightrope across to the soft landing other side, and we're almost there. We're like 6 months away. If we get hit with a tariff shock or a fiscal shock right at that very end, it could knock us over. If we get to the other side, small businesses come back to life, there's been enough rate cuts, lower income consumers feel better, then we can take some winds of change. But the next 6 to 12 months is going to be really critical. This economy is still wobbly.
So you see a real chance of potentially a no landing after what everyone is viewing as this soft landing scenario we're in right now?
Oh, certainly not our base case, but let's do a thought experiment where by the end of this year, we have tariffs that need to get priced in. We have inflation that's still running hot. We have super core inflation, Powell's most favorite, running above 4%. Small businesses are still struggling. Remember, they hire 80% of folks in the United States. They're still very depressed and dealing with uncertainty. If we get some sort of negative shock before we get some of the advantages of Trump policies like deregulation, then yes, there is still an area, I'd say about 20%, where we get knocked off. That doesn't merit a base case, but if you're planning out your business or you're making long-term investment decisions, it can't be eradicated as a possibility we have to evaluate.
Any thoughts on who's running the Fed when we're having these conversations in 2026?
No, but all I know is back in 2018, Chair Powell said when you're in a dark room or you're in a room and someone turns off the lights, you have to move more slowly. That is the Powell that we have right now. That is the Powell that we evaluate. He'll probably be moving a little bit more slowly as we walk through this darkened room.
This was great. Frances, it's good to see you.
Thanks, Howard.
Thank you. Thank you so much. Frances Donald there of RBC here in New York with us. Let's turn to the price action in financial markets and start with the equity market. The S&P 500 on a 5-day run. This morning is day 6. Outperformance on the Russell. You can see the S&P 500 there up by 0.5%. On the Nasdaq 100 higher by 0.6. On the small caps up by 1.2. If you switch at the board and turn the page and get to the bond market, 2-year, 10-year and 30-year. Yields this morning lower by almost 7 basis points now at the front end of the curve. On a 2-year, just about holding on to 430. Right there with you is the 10-year at 432. Yields are lower this morning now by 8 basis points on the session.
Yeah, how much is this a relief rally and how much is this something sustainable at a time where the person chosen for Treasury Secretary is someone who cares about the deficit and also is well respected on Wall Street? It's not someone looking to shake things up.
Cares about the deficit, so that's good for the bond market. And then for stocks, Jonathan, you said it. It's the Besant bump this morning. I just want to know how long it lasts. How long does this all last? The Trump trade, the Besant bump.
We'll see how long it sticks. I think you've got to get a more complete picture of who the people are that are going to be running policy. Then you've got to understand where the emphasis will be, taxes, tariffs. Immigration's a big piece of this as well, which is the argument that Frances Donald was making just moments ago.
Yeah, especially if we are dealing with an aging population, retirements. At the same time, you have to wonder Mike Wilson's view on efficiency, on the idea of AI application, how much that could actually reduce the need for some of these workers. These are some of the sort of push-pull that you can argue on either side, which is the reason why he's actively trading and maybe doing that more than the long-term calls.
For now, we're buying equities. Stocks at session highs this morning. The S&P 500 looking for its 6th consecutive day of gains. Noel Dixon of State Street writing this. For now, equities are looking to the bright side of a normalizing Federal Reserve, stronger U.S. economic growth, deregulation, tax cuts from the new administration. This narrative can easily change if we are faced with the Fed pausing for inflation and fiscal concerns early next year. Noel joins us now for more. Noel, it's good to see you.
Good to see you.
Do you think that's the scenario we will be facing in 25?
I think so. I think there's, some euphoria. Obviously, we got the red wave. Everyone's looking to the positive parts of the policy. But we're going to get into a situation where, like I said, the Fed is easing into strength. You have these fiscal issues. Tariffs, I think, will be a big risk event. So I think those concerns come up in the first half of next year.
So what are you advocating for into next year?
Yeah, so I think I would probably take some risk off the table coming into next year. I also think the dollar will continue to grind higher. I think that it's sort of the U.S. will continue to be the cleanest dirty shirt. And I think we'll have probably lower global growth if we do get that tariff policy implemented.
This might be a dumb question. What is risk? What counts as that? Because some people are talking about risk in stocks. Other people are saying risk is in duration and the chance that maybe there isn't necessarily any kind of controlling force in the deficit and that you do end up, like Francis Donald said, with even rate hikes by the end of next year.
Yeah, so I think the biggest risk is in the long end of the curve. I think duration is that's what you want to focus on taking off. I think equities, they had a big rally. Right now, like I mentioned before, it's sort of what's not to like. But, when we get into next year, it's going to say what is there to like, because you're going to have overvalued equities. You're going to have this fiscal concern moving into next year. And then you're going to have a Fed that's going to be forced to pause its policy.
So you're not buying the Besant bump?
I'm not. I think, again, I don't want to go against it in the short run. I think you kind of ride the wave. Maybe you get a Santa Claus rally. But once we get a little dose of reality into 2025, I think that's when you want to start to take some risk off.
You say tariffs are the biggest risk. Do you view tariffs, or do you think this administration will view tariffs as a negotiating tool to reset the playing field when it comes to free trade? Or do you actually think they're going to use them as pay-fors for their tax cuts, which would then mean that the sequencing has to be in parallel?
I think it's the latter. I think the administration perceives tariffs as a way to pay for some of the tax cuts that are going to come through. But I think what they forget is that, tariffs are going to go one way. It's either going to impact the consumer, so companies will pass the cost on, or it will put some pressure on corporate margins. So I think that probably is a misguided sort of focus. But I do think their perception is that it'll pay for some of the tax cuts.
So if this is your base case, what does someone like Scott Bessent at the Treasury mean for that impulse that some other members of the administration might have when it comes to tariffs?
Yeah, so I think the initial reaction is that he's more of a pragmatist. But we have to realize that Trump won the popular vote. So I believe from his perspective, he thinks he has a mandate. And he, as he said before, his favorite word is tariff. So I think, Bessent, his perspective is he would like to ease things in. But I feel like Trump is going to want to implement that policy.
Are these tariffs a bigger problem for the rest of the world than they are the United States?
I don't think so. I think it's a problem for everyone because I think naturally you're going to get retaliatory reaction from other countries. I think when we look at the first administration, the retaliatory tariffs actually impacted the U.S. exporters disproportionately to the importers.
These were some of the farming producing states. Agricultural commodities, they were the big focus then. Should we be focused on anything else?
I think because tariffs are across the board, I think everything should be a focus. I think it's going to be, a real different sort of scenario. We're at a very different
You're
starting
really
point.
expecting those blanket tariffs that have been promised on campaign trail. You think they could become reality?
I think so. He promised it. He won the popular vote. I believe, that's what he campaigned on. That's what kind of drove him into the White House. And I think he's going to continue to focus on that path.
So just to sort of put a bow on it or underscore what you're saying, is that the dose of reality that you think will really curtail what could be a Santa Claus rally in this melt-up?
I think so. I think, markets are sort of waiting for the clarity on that. I would augment that, obviously, with just the fiscal spending. We already have structural deficits. So all of that combined, that's something the Fed's going to have to focus on. And when they have to pause for that reason, it could cause some risk off.
Who's the biggest loser in a trade war?
I think the biggest loser probably, I would say, China initially, because their economy is already pretty weak. They've planned for it, I'm assuming, but, they still are in a very vulnerable position. I would say outside of that, I think Europe is very vulnerable as well.
No, appreciate your time. Thank you, sir. No, Dixon there of State
My
Street.
pleasure.
Europe's vulnerable. We heard that from Jane Foley of Rabobank earlier on this morning. It's why she thinks euro-dollar can drop towards parity as we work our way through next year. This just dropped from Barclays. Bridled enthusiasm. They say unbridled enthusiasm, ? Hold your horses. They go on to say the macro is slowing to still healthy levels, should support more US equity upside next year, albeit a deceleration from 23-24's breakneck pace. The outlook for 2025, price target on the S&P, Lisa, raised to 6,600.
Which seems to be kind of the median. We got that kind of range from Lori Calvasina over at RBC overnight. She basically set that target at 6,600 as the median, 6,200 to 6,700 as the range. Scott Rubner of Goldman Sachs saying 6,200 for year-end this year, saying, I don't think that many will be eating turkey on Thursday and then shorting the S&P.
This other line from Barclays, go bigly or go home. Which is a line I like. OK, they win the morning with that line right there. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Macy's is delaying its third quarter earnings due to an investigation. The company saying a single employee responsible for small package delivery expense accounting intentionally made erroneous entries to hide about $132 to $154 million of expenses. Macy's saying the employee no longer works for the company. Let's stop recovering. It's down by 0.7%. And wait for this. I didn't make this one up. Apparently this is real. Glickard.
Oh, God.
Get it? Glickard.
Oh, no.
Leading a massive weekend at the box office, Wicked and Gladiator 2 brought in a combined $170 million in US and Canadian theatres. Wicked took the top spot with $114 million in ticket sales. Gladiator 2 brought in $56 million to finish second. And finally, President Biden participating in the annual turkey pardon at 11 a.m. this morning. Turkey's Peach and Blossom will get a mealtime reprieve from Biden and then return to live out their days in Minnesota. It is believed that Abraham Lincoln was the first president to pardon a turkey back in 1863.
So I love NPR this morning. A lame duck president will pardon a turkey. It's a tradition. I always wonder what people outside of the United States think of this. Like, what is going on in America?
Have you been to this before?
I've seen it from afar.
OK. Just didn't attempt.
Didn't attend.
You're like one of those that stood by the fence and watched it happen.
Yeah, or from a video, forced to talk about it. But there's no policy involved in this. So to be honest, I'm just not that interested.
Just a bit of fun before the holidays, AMH. Lighten up. Up next on the programme, setting you up for the day ahead from New York. This is Bloomberg. You know when a CEO gets fired in the stock rallies, and it always feels like a real slap in the face for the person who used to run the company? This is like the reverse of that for Scott Bessent this morning, who must be feeling pretty good looking at markets and knowing that some of this, at least, just a small part of it, is about him getting the nod for Treasury Secretary. Equities up across the board here. The Russell of small caps up by 1.35%, a rally in the bond market. Yields are lower by 8 basis points on a US 10-year. We're down by 6 at the front end of the curve. And that unlocks some real dollar weakness. Euro-dollar session highs up by 1 full percentage point and taking out 105.18 on the euro. As we count you down to the opening bell, here's the trading diary, the calendar for the next few days. Tomorrow, we'll get Nordstrom earnings after the closing bell, plus the eco data parade kicking off with consumer confidence, new home sales and Fed minutes on Wednesday. We'll get durable goods, core PCE, and another round of jobless claims on Thursday, of course. US markets will be closed for Thanksgiving. They're open this morning, and one stock to watch is Macy's. The shares falling in the pre-market earlier, still down by 1.2%. The company delaying its third quarter earnings after an investigation revealed a single employee hid tens of millions of dollars of expenses. Bloomberg's Emily Cohn joins us now for more. Emily, good morning.
Good morning.
What on earth happened here?
We don't know too much yet. We know one employee is responsible for allegedly hiding more than $100 million in expenses. The company was due to announce its earnings tomorrow. They delayed that. They gave us a preliminary look. The stock fell dramatically when this came out, and the losses have pared a bit now that people have realized the limited financial impact of the probe. But we don't know a whole lot yet.
Is it going to actually be to everyone's advantage, analyzing the company, that they're going to be releasing after the Thanksgiving holiday, after the parade, when we get a sense of what Black Friday was like?
That's what I'm hoping for. So the fact that they're delaying their earnings can actually tell us a little bit more about the American shopper, the American consumer, anything about the economy. Macy's is often seen as this barometer of how the mass market American consumer is faring. And how those consumers are spending during the holiday shopping season is going to tell us a lot about the American consumer. It's kind of nice that now their earnings are delayed until after Thanksgiving, most likely. We actually don't know when it's coming. I think they said sometime before December 11th. But if it's after Thanksgiving weekend, we might actually get a little bit more color, a little bit more of a preview on how holiday shopping is looking. In the preliminary earnings today, Tony Springs said that November comp sales are trading ahead of 3Q across all their brands. But that should be expected given where we are in the holiday season.
In general, how is the holiday season looking?
It's starting off okay, nothing stellar. But this is the week. This is the big week. I think a lot of stores, the holiday shopping season this year is interesting. It's going to be shorter than ever because Thanksgiving is falling so late in the calendar. So we saw a lot of those sales start in October this year, even into the summer months. So starting off okay, but we'll see a lot more later this week.
Is the parade still happening? It's all Anne-Marie wants to know.
I believe so. I haven't heard anything otherwise.
This one rogue employee is not ruining the parade.
Can you imagine? That would be quite the statement. He killed Snoopy.
Emily, it's good to see you. Thanks for
Thank you
dropping
so
by.
much.
Still trying to work out what's happened here over at Macy's. Emily Cohn there. That stock is down by about 0.9%. Coming up tomorrow, a big lineup for you. We'll catch up with Stuart Kaiser of Citi. Matt Lazzetti of Deutsche Bank is the one to watch. Matt Lazzetti of Deutsche Bank thinks that maybe you get another rate cut in December, and then this Federal Reserve is done for the whole of 2025. So looking forward to catching up with him. Then we'll catch up with Liz Ann Saunders of Charles Schwab and Sarah House of Wells Fargo. As we count you down to the opening bell, this equity market is starting to rip. Equity futures right now on the S&P 500 higher by 0.75%. A big rally in the bond market, yields are lower by 8 basis points, 432. And in foreign exchange, some dollar weakness. The euro reclaims 105. A thank you for a Thanksgiving over at Scott Besson's house, maybe. From New York, this is Bloomberg.